selling put options. The same strategy that I have used to scale my personal portfolio to multiple seven figures, same strategy that someone like Warren Buffett actually uses that's not really talked about. And it's the same strategy that I have seen traders at Goldman Sachs, where I used to work, use as well. Today, I'm going to be teaching you everything, and I mean everything. I'm not going to be holding back about selling put options. All the timestamps are going to be on the screen right now in this course. I'm going to be breaking this down for a beginner. So even if you've absolutely never even sold a put option, you can understand how to do so and the best techniques based on my own experience. So here's the thing. Most people teaching this strategy online are either overcomplicating it or leaving out crucial details that could cost you thousands of dollars. So grab a coffee, get comfortable, because the next couple hours, I'm going to give you the complete education on selling puts that most people charge thousands of dollars for. And I'm going to give it to you for absolutely free. Okay, if you appreciate that, subscribe. Let's jump right into it. So why should you even bother selling put options? Before I explain what put options are, I promise that I'm going to make this super simple in just 1 minute. Let me tell you why you should care about this strategy. Goldman Sachs released a report showing that systemically selling put options 3.4% per month premium collected is about 49% annual premium collected, okay? Now, you won't always get the complete return because you're not gonna win on every single trade that you make. But the good news is, even when it doesn't go your way, quote unquote, it's still a good thing, because when you sell a put option, one of the things that can happen to you is assignment, but assignment is a good thing. It's a good thing because we only sell puts on stocks that we like. We'll get into a lot more details on that, but I want you to first understand that not every trade will go your way. Warren Buffett, one of the most famous investors, he actually sells puts all the time. We just don't see it in the filings. There's something called a 13F filing that investors get to see that big hedge funds and big money managers put out there, but options are not shown. But there's a lot of research and there's a lot of evidence that Warren Buffett is very much an options seller. He just doesn't talk about it. And it's a core strategy that you need to understand on a deep level as a building block for another strategy, such as the wheel strategy that starts off with a sell put strategy. So this is the most important course that you can watch on the subject of selling put options. When you sell a put option, someone like Warren Buffett would do that because you're your own little insurance business, in fact, when you're selling put options. Because a put option is an insurance in the market for a stock that may fall. Someone may buy a put option protecting themselves or paying money for protection because they're buying insurance. That's what a put option is. It benefits if the stock goes down, and you have to pay for that benefit. But if you're the one selling it, you are the one providing insurance, okay? Some of the most profitable businesses in the world are insurance businesses because they're exploiting or arbitraging the difference between what someone is willing to pay for protection and the amount of money that is actually that risk, okay? If there's 1,000 people that buy insurance for their car and they pay, $1,000, that's $1 million in collected premium, right? And if only 3 or 4 or 5 people get in an accident, then you have to pay out $10,000. You've made $1 million, but you're paying out $50 in insurance claims. Here's why this strategy is the most powerful strategy out there. When you buy a stock, you only make money if it goes up. When you sell a put, you make money because of the premium that you collect. If the stock goes up, you make money because you already collected premium. If the stock stays flat, you still made money. Nothing happens to your position. Even if it drops a little bit and it stays above the strike price that you sold that put option for, you do not take assignment. So you still get the premium. I'm gonna show you plenty of examples. Don't you worry. So you only lose on a sell put if it drops significantly. Instead of needing to be right about direction, you just need to avoid being very wrong. That is a much easier game to win. You see, even if it goes slightly down and it's out of the money, you're good. Even if you get assigned, it's okay if you like the stock. Think about it like this. Imagine that you want to buy a house that's currently listed for $500,000, but you think it's really worth about $450,000. Normally, you'd have to wait and really just hope that that price of the house goes down. It may never go down. But what if someone paid you, yeah, they actually paid you $10,000 today to agree to buy that house for $450,000 anytime in the next 3 months. So if the price drops to $450,000, you have to buy the house. You're obligated to do so. And you get to have $10,000 because of that obligation. Well, is that really a bad thing? You want the house for $450,000, but now you're getting paid to do it. Yes, you have an obligation, but you want it. You want that obligation, right? So you're getting paid to buy an asset that you want to buy it anyways. The beauty of put selling is that time is on your side. Every day that passes, the option actually loses value through time decay, which benefits you as a seller. It's like being the casino instead of the gambler. If you buy Apple for $280, your break even is $280, right? Whatever you bought it for. But if you sell a put option for $270 and you collect $5 in premium, your break even is now $265. You have more cushion, more room for error, and you're getting paid to take on risk. Well, let's break it down exactly what a put option is and start from absolute zero. I'm going to explain this so simply that you can teach it to a 5th grader. An option is a contract. That's it. It's a piece of paper, well, electronic paper, that gives someone the right to do something. A put option specifically gives the owner the right to sell 100 shares of a stock at a specific price by a specific date. Let's start with buying a put so that you understand both sides. If a buy put option on Tesla at 400 strike price, you are buying the right to sell 100 shares of Tesla at 400, no matter what the actual price of Tesla is. If Tesla drops to 350, you can still sell it for $400 using your put option that you purchased. It's like insurance. You pay a premium for protection against the stock dropping. Now here's where things get really interesting. For every buyer, there needs to be a seller. Someone has to sell that insurance. That's where we come in play. When you sell a put option, you're selling someone else the right to sell you their shares at a specific price. You are the insurance company. Let's make this super concrete. Say Microsoft is trading for $480 per share. You sell a put option for $470 strike price for a $5 premium. You're saying, I will buy Microsoft for $470 anytime in the next month. For making this promise, you immediately collect $500. Remember, each option contract is worth 100 shares, so $5 is really $500. Now, one of two things can happen. Either Microsoft stays above 470 and the put expires worthless and you get to keep the $500 and your obligation completely disappears, or Microsoft drops below 470 and you have to buy 100 shares at $470. But remember, you collected $5 in premium, so your actual cost is $465 per share. This brings us to the crucial distinction between cash secured puts and naked puts. A cash secured put means that you have the full cash in your account to buy shares if assigned. If you're selling a 470 put on Microsoft, you need $47,000 in cash sitting there. It's a fully secured, fully covered, totally safe from margin call perspective. A naked put means that you do not have the cash. I do not personally recommend this at all. You are using margin or hoping that you won't get assigned. That is incredibly dangerous. If Microsoft drops to $400 and you don't have $47,000 to buy the shares, your broker will liquidate your position or hit you with a margin call. People have completely blown up their accounts with naked puts, so I do not recommend them. We're only going to be talking about cash secured puts in this course. Always have the cash to back up your puts. It's like writing checks. Don't write a check if you don't have the cash in your account. Pretty sure you can't even do that, right? But anyways, have the cash available. This means that your put that you're selling is going to be a cash secured put. The key learning about selling puts is it's always a win-win situation if you want to own the stock. You see, when you sell a put option, you're obligated to buy a stock, and since you picked the strike price and you want to pick a strike price lower than the value of the current stock price, that means that you get a discount. Not only do you get a discount though, every time you sell an option, you collect premium. So you're making income. you are collecting and generating income in your portfolio and you're buying stocks that you want to buy anyways. Either you collect premium for nothing, literally nothing happens, or you buy a stock that you wanted to for a discount. The only loss scenario is that the stock drops significantly, way below your strike price. But even then, you are buying a stock that you agreed to buy, that you wanted to buy anyways. And had you bought that stock and you didn't sell a put option, you would actually be in a worse scenario. Let me give you real numbers to show you the power. I sold a put option on AMD at $200 when it was trading at $215 per share. I collected $3 in premium. AMD dropped to $198 at expiration. I had to buy it for $200, while my cost basis was actually $197 because $200 minus $3 of premium makes it $197. AMD is now back to $205 per share, and I personally made a total of $8 per share. If I had just bought it for $215 per share originally, I'd be way down on my money. Now, let's talk about how to pick the best strike price. Choosing the right strike price is probably the most important decision in put selling. Get this wrong, you're either collecting pennies in premium or you're getting assigned on every single trade. Get it right, and you'll have the perfect balance of income, whether it's weekly or monthly income, and you'll have a perfect balance of probability of success. The strike price is the price at which you are agreeing to buy the stock. If you're selling a put on Apple at 270 strike, you're saying, I'll buy Apple at 270. The further below the current price you go, the less you have to pay. Yes, you may get assigned, but the lower the assignment chance. The lower that you go, the lower the assignment chance, and the lower your average cost becomes. However, the lower that you go, the farther away, the less the premium that you collect, because everyone else knows that this is a safe trade. And traders who want to hedge and buy put options, they're willing to pay less for options that are further lower and out of the money. Here's my framework for choosing strikes. First, identify a price where you genuinely will be happy to own the stock. Not tolerate owning it, but genuinely happy. If Google is at 325 and you'd love to own it at 310, that is the point that you want to pick a strike price. Now, look at the technical level. Where is support? If Google has bounced off of 315 3 times in the past month, selling the 315 put is less risky because the stock is bouncing off of those levels often. Another key important factor is the premium to risk ratio. This is very crucial. I want to collect at least 1% of the strike price and premium for a weekly option. For a monthly option, I really want to get closer to that 4% mark. So for a $100 stock, I want at least $1 in premium. For a $300 stock like Google, I want $3 in premium. Here's a specific example using NVIDIA stock.
Let's take a look at my portfolio right now. Let's go through where it makes sense to sell put options for a premium and where it does not make sense. For example, if I go to NVIDIA, we're going to show you that basically collecting a lot of money is imperative for a more expensive stock. So if I go to, let's say, expiration of February 20 expiration, and then if I sell a put option, say at 165, you can see how the premium here is $7.30, which is like, as a percentage, that's the most important thing, right? So as a percentage, $7.30 is like almost a 5-ish% return. And this is a pretty out of the money option. So this is good because it's a 32 delta. So that's exactly the sweet spot that I typically go for. And if you compare this versus something else, it won't make sense. So one stock I used to look into a lot was Kraft Heinz. Now Kraft Heinz is a stock that I was looking into a lot because Warren Buffett has it. The stock I thought was pretty safe, but I haven't had it for a while. Just hasn't been performing. I'm going to show you the premium here. Premium is just super, super low. So if I go for, interestingly enough, they don't have February expiry, but it's so bad that even if I go for like March, right, and I go for like 30 delta, that's a 9 delta, so not that. 22.5, it's a little lower than 30 delta, but the premium here is just not that attractive. The premium is a lot less than NVIDIA, and a big part of that is just because of lower volatility.
By the way, this is something that I do for you in my community. I will sell put options on my Monday calls, and I'll open up positions for the month where my students can copy me and learn from me, see the technical analysis that I do, and understand the stock selection process that I go through when I sell my put options. If you're interested in learning more about that, it is the first link in the description. Now let's talk about how to pick the best expiration date. After the strike price, expiration date is your second biggest decision. This determines how long you're committed to the trade and how much time decay that you're actually collecting. The sweet spot for most put sellers is somewhere between 30 to 45 days expiration. Why? This is where theta decay really accelerates. Options lose value slowly at first, but then rapidly in the last month. By selling 30 to 45 days out, you're actually selling when time decay is at its highest and it's speeding up. That time decay that eats into the option reduces the option's price. But since you've already sold that option, that reduction in price is actually the profit that you're making if you wanted to close a sell put option at that point of time. You don't have to hold an option till expiration. In fact, you're free to make profit anytime that you wish. You can sell a put option and then within, say a week, if you've made 50% returns, then it makes sense for you to take profit and just close that option out for a gain. Let me show you the math. A 90-day option might have $4 in time value. After 30 days, it might still have $3. That's a $1 decay in 30 days. But from 60 days to 30 days, it might go from $3 to $1.50. That's a $1.50 decay in 3 days. From 30 days to 0, it goes from $1.50 down to 0, right? That's another $1.50 in time decay. But really, I'm just giving you an example. What oftentimes happens is it's $1 and then it's $1.50 and it's $2 and it increases and it rapidly decays very quickly. Okay, so it's an increasing decaying amount. And I can actually show you theta right now. Let's go over an example of theta in time decay for different expiry dates for several different options.
All right, guys, let's talk about theta right now on options that expire like pretty soon versus options that don't expire soon at all. So I'll say this option on Google, right? So this option is expiring very soon. It's expiring in basically this week, right? So I'm up $10,000 on it. And if I show you the theta right here, you'll see that the theta is 0.16. Since each option is 100 shares, this is actually $16 in theta per day on an option that's expiring very soon, right? So let's just compare this option that's expiring on expiration is 12/19, which is this week as I'm making this video. So that's very short term, right? Just a few days, $16 in theta decay. But now if I show you another option, let's go for an option that's maybe not expiring anytime soon at all. Let's go to Walmart. This option is expiring in September 2026. And the theta here is 0.02. So basically this is only losing $2 worth of value per day. So that's a really huge difference, 2 versus 16. Let's just look at a third option as well. I just want to show you something maybe in between. It does depend on many factors, but theta in itself is just how much the option is losing value per day, which is really nice because if you sold a put option and you look at the theta, that's basically how much it's losing per day, which is a good thing because when theta is eating away at the option, that's actually exactly how much money you're personally making if you were to close that option, right? Let's actually go through another example. I'll show you what I mean. So let's go to NVIDIA 184 put option here that I have, which is in the money. So let's go down. The theta here is 0.09, right? So this option is going to get $9 cheaper per contract per day. If the stock stays the same and all other factors are the same, which almost never happens, but the theta itself means that tomorrow, if everything else is the same, then this option will be worth $9 less, okay? And because I sold this option, it being worth $9 less means that I am making $9 per day on this option specifically. So if I had 10 contracts, then I'd be making $90 per day in theta decay. Let's do one last example. I want to go for something that's a bit more out of the money. So in medium term, so let's go for, I have a pretty good position on VCHR. So ACHR is very out of the money. So I have an $11 covered call here. This is a covered call position, so I won't spend too much time on it. But I'm up $20,000. The theta is super, super small. That's because I've already made so much money on this option. It's already up 95%, $20,000. But that's a covered call. So let's go to another sell put. Let's go for a sell put on Palantir here. I have a 150 sell put on Palantir. It's very out of the money. And theta here is also about $8 a day. So it fluctuates. And essentially, the more out of the money the option is and the less time there is, then basically that's how fast theta is going to start kicking in.
Now, I personally love monthly options. They're super simple, they're very low maintenance, and it's the best for busy professionals. Oftentimes, I work with professionals such as engineers, IT professionals, business owners, nurse practitioners, and you basically name it, dentists, etc., right? Those professionals are very busy, so monthly options is the best form of expiry date because you don't have to do too much work. But some people really like weekly options as well. Weekly options can be good as well, especially if you want to get assigned quickly or you really want high time decay. That's fine, but just understand that transaction costs do add up with weeklies. Even if you're paying zero commissions, you're still dealing with the bid and ask spread. So if you're trading 52 times per year versus 12 times per year, you have an extra 40 bid ask spreads that you have traded, right? Let me show you an example right now of bid ask spread and why trading more is not better.
Let's talk about bid ask spread and why trading a lot of options is actually not a good thing, because every time you trade, you're basically going to lose money to the bid ask spread. So let's go over an example and let's just go to Palantir. Let's go to trade Palantir options. Let's say that we want to do like weekly expiries, right? We want to go super short term. I'm going to show you right now why you're going to be spending a lot of money on the bid ask spread if you go for really short term options. So for example, if I go for 172.5 sell put here, and I expand this, you can see that the bid is 116 and the ask is 120, which is actually not that bad. It's only a $4 gap. So you're not going to get filled though for 116 or for really 120. So if you want to buy this option, you're going to have to buy it closer to the asking price of 120. If you want to sell this option, you're going to be selling it closer to the 116 bid price, right? So in reality, what's going to happen is you're going to get filled at the mark. So the mark here is 118. So 118 is like the midpoint. So every time you sell a put option, you're technically losing $2, right? Because, you know, you're selling it for 118, but someone's asking for 120, right? But you're only getting 118. So you're losing $2. If you were to do this trade, for example, every single week, 4 times, then it's going to be $8 that you're losing out in terms of the bid ask spread. That's not a lot because I'm showing you like a super efficient stock, which is Palantir. But if I show you right now, something like that's not as efficient, let's see if Mara, stock that I don't trade, by the way, but it's on my watch list. Let's see if the bid ask spread here is worse. I assume it is. No, it's not. It's only a 5-cent difference, right? So that, if I can bet, I'm going to find it as something that has a pretty wide gap. Costco, actually. So Costco specifically is really wide. But let's say like on a sell put, you wanted to go for like the 870. So here you can see the bid ask is a lot bigger. It's a lot wider. So 435 and 480, that's going to be a difference of $45. So every time you trade, you're going to be losing $20. Now that is then going to add up, right? So like that's $80 a month if you do this trade 4 times in a month instead of just doing it once. It's $20 worth of fees versus $80 in fees. So although you think it's free, it's really not. So you're going to be paying fees in terms of the bid ask spread. The tighter the bid ask spread, the better. And typically that's really liquid stocks. So like Apple's going to be even tighter than Palantir. So if I go to Apple right now, I'm going to go for the 275. Okay, interestingly enough, the market is not open as I'm filming this. So it's probably going to change when the market opens up. Typically Apple has like literally the tightest bid ask spread ever because there's just so much volume. So there's like literally $1 or $2 difference, and that's pretty much no difference at all. $1 or $2, then you're losing like 50 cents or $1, and that's a lot better than obviously $2. $2 is better than $45.
Now, management time is also really brutal with weekly options. You're constantly monitoring, rolling, adjusting, and placing new trades. It really does become a full-time job, which is why I do not recommend it. With monthlies, you check in just once a week. If everything is fine, you don't have to do any adjustments. You don't have to do anything. Just continue on with life, your job, your family, etc., right? So here's when I do use weeklies. Only during very high volatility events when premium is elevated, or when I'm trying to avoid a specific event like earnings. Otherwise, I stick with 30 to 45 day options that expire on a frequent basis, but not too frequently. Let me give you a real comparison. Selling weekly puts on Tesla at 410 strike price might pay you $3 per week. Over 4 weeks, that's $12. But selling a monthly put option at the same strike price might pay you $10. So weeklies may pay you $2 more. But that's a maybe because the stock still moves, right? There's no promise that after that 1 week that Tesla will still be at that price. So you may not even be able to sell another option at that price for that amount, right? So that's why I do like to lock in a price, and I like to do monthly options. By the way, the 45-day expiry is even more simple. And if you're a beginner, you're learning from me, you're probably more excited to make more trades. But a lot of the members in my Discord community, as they gain more experience and they realize that they're hitting all their retirement goals, oftentimes they start to back off that monthly expiry. They might even go to something like 45 days to expiration, which is honestly one of my personal favorites. It's even less management. Every 6 weeks is even less work. It's long enough to give the trade time to work, but short enough for time decay to be very meaningful. Plus, many stocks have monthly expiry cycles that fall around 45 days. There's a traditional expiry That is the third Friday of the month. Third Friday of the month is oftentimes the strike that I personally pick. So let's talk about delta. What is delta and why is it so crucial? Delta is the most important Greek for put sellers, and if you only learn one Greek, this should be it, is delta. Delta tells you two critical things: how much the option's price changes when the stock moves, and the second thing it tells you is the approximate probability of the option expiring in the money. Let's start with the price relationship. If a put option has a delta of 0.3, it means the option price will change by 30 cents for every $1 move in the stock. If Apple goes from 280 to 279, a 30 delta put option will increase by 30 cents in value. As the seller, that's a $30 paper loss per contract. But here's the more important use of delta, and that is probability or chance. A 30 delta put has an approximate 30% chance of expiring in the money. That means there's a 70% chance of keeping your full premium. This is why delta is so powerful for put sellers. It gives you your odds of success. My sweet spot is selling puts with a delta around 30. Why? Well, it's the perfect balance between premium and probability. At 30 delta, I'm winning about 70% of the time. In fact, with my techniques and the technical analysis that I'll show you later in this video, as well as my stock selecting process, that probability is actually a lot higher. But mathematically speaking, the delta shows a chance of profit of around 70% because there's a chance of being assigned the 30, okay? Now, a 70% chance of not getting assigned is enough to be profitable long-term, even if there's an occasional loss. In fact, because when we sell a put option, we want to buy the stock anyways, you can in theory say there can never really be a loss, because the worst that can happen is we will get assigned on a stock that we want to own anyways. But I'm just speaking about the option itself. Of course, the option itself can show a loss if you wanted to buy it back at that point in time. I don't usually recommend that, but there are some situations. If you sell a 0.5 delta put, which is at the money, you're flipping a coin. 50% chance of assignment, 50% chance of no assignment. The premium is much higher, but you're getting assigned half of the time. That's not income generation. That's just buying the stock with a few extra steps. If you sell a 0.1 delta put, which is really, really far out of the money, you'll almost never get assigned. You'll have a 90% win rate. Sounds good, right? But not really, because just because you win 90% of the time doesn't mean that you're automatically super profitable. In fact, what if I told you that you can win 99% of the time, but every time you win it's just $1, okay? Not that attractive, right? It all depends on how big the win is, and that's where I look for the sweet spot for delta. And I'll show you more examples when we go over the live trading, but for now, just understand that win rate isn't the most important thing. In fact, it always upsets me when I see other traders, influencers, content creators that a lot of them have been through my program, they boast a big win rate. I win 89 or whatever percent of the time. I don't like that because it can be very deceiving. Okay, I don't like deceiving beginners. So the win rate, for now, just understand that it's a chances you will get assigned, but it's not the end all be all. Your profitability will vary on more factors that I'm going to be discussing in this course. Let me pull up the option chain right now and show you various different deltas and which deltas I would pick for various different stocks.
All right, guys, let's talk about several different examples on selling puts and the deltas. Let's say that we really want to own a stock, right? We really want to own it, and we see a lot of bullish activity on the stock, and there's a huge recovery. So like one of those stocks right now, one that I follow pretty often is Chipotle, right? Chipotle has been gaining. So in the last 1 month, you can see here it's actually up a lot. So if we don't want to miss out on the bull run and we want to sell a put option, how can we do that while making like a lot of money? You would do that by going for a higher delta. So for example, I'm going to show you something interesting. I can actually sell an in the money delta. So if I go for January expiry 2026 and I go for sell put option, I'm going to look at selling something that's actually going to be in the money. These are really weird at 36.6, 36.4. But anyways, the stock's at 36.12, right? So I can sell the 37 put here, and that's going to collect a lot of income. It's going to be $1.56, which is a really massive return percentage in a very short amount of time. Now, why would I do this? The whole reason that I would do something like this that has a delta of 56, let me actually show you even something more interesting. So if I go for 38 delta, 38 strike price, excuse me, and I expand this option, you'll see that there's like a 67 delta. So you would go for a much higher delta when you literally just don't mind getting assigned. So if I want to only is on a bull run and I don't want to miss out, I can the most massivest premium ever by going for an in the money put option. But of course, if Tripoli does not go up, I'm going to get assigned. But again, that's okay if you want to own the stock, right? So you can actually go for higher deltas when assignment is something that you want. You really want to get assigned, so you can pick a higher delta. Now, let me show you something where I would pick like maybe a 30 delta, and then I'll show you something where I would be like more cautious and go for a much smaller delta. So if I were to go for, let's say I wanted to go for Archer right now. Archer's down a lot, 7 years to date. So yeah, it's near like kind of at the bottom here. There's a really strong support around 718. So if I were to go for an option on Archer, let's say January 16, and I go to sell put, then it would be pretty easy for you to sell the $7 put, although it would be a lot lower delta. So this is where I would probably go lower delta. If it's a stock that I'm like less certain on, it's not like a blue chip stock. Archer is a much smaller company. So here I can go for a delta that's 18. And honestly, I wouldn't even worry about it because the delta is so small. It's also at the support level of Archer. So this is where I would be more cautious and I would go for an 18 delta. It would not make sense to go for a 9 put option because the delta here is 58. And despite the bid-ask spread being really amazing, the stock may end up falling more. So unless this is a stock that you see in the bull run, like Chipotle I showed you, then in this case, Archer would only pretty much be a negative for you to do a high delta on.
All right, hope that you enjoyed that clip of using various deltas in the mindset that I have around the reasons I would use those deltas. Here's how I also use delta in practice. I pull up an option chain for something like Meta. Say Meta is currently trading for 640. I scan the puts and I just look for the most simple delta, which is 30 delta. And then I analyze the premium and I see for myself, is the premium attractive? I take the premium and I divide it by the strike price to see what the return is for that period. This tells me how much money I am making. So for example, let's say that there's an option that has a strike price of 80 and the premium has, $4. Well, I would take $4 and I would divide it by 80 and I would get a 5% return. And if that option is expiring in just 3 weeks, well, that means I can make 5% in 3 weeks. And that tells me if the option is attractive or not. That's one of the key components because you can find a good stock, but if the option doesn't pay you that much premium, then it's not that attractive. And one of the key components, by the way, of an attractive option is higher implied volatility. Let's quickly show you an example of what higher implied volatility does to an option and how it affects the Greeks and how it affects the option premium. Now, let's talk about the relationship between delta and time. Two very, very important metrics, okay? So delta and time is very fascinating. As expiration approaches, delta moves towards 0 or towards 1, okay? It's one or the other. It's not gonna stay the same because if an option is out of the money, then it's going to move towards 0. As expiration approaches and that option is nowhere close to the strike price, then it's gonna go towards a 0 delta. However, if it's in the money, okay, the closer it goes to expiry, it's pretty much for sure going to expire in the money, right? So imagine you sell a put option on Meta at 640 and, Meta is at 680. Well, that option is going to be, let's say, a 30 delta. And as time approaches, that 680 price and the 640 strike price, they're far away from each other. And because they're far away, the option will go from a delta of 30 down to 20, down to 10, down to 5, and down to 0 on Friday of expiration. It'll be basically 0.01. It'll be something really, really small, right? And then it'll expire out of the money, right? Now, on the flip side, if Meta ends up going down to, $590, which is where support is at, right? I was looking at Meta this morning as I'm making this video. 590 is the support. Okay, if Meta ends up tanking and goes to the support level and it stays at 590, well, that's an in-the-money option. It's below the 640 put option that you sold. And for that reason, the delta is going to go towards 100 at expiration. So it's going to approach 1. It's going to be a 1 delta, which is for sure going to happen, right? For sure it's going to expire in the money, and then for sure you are going to get assigned on that sell put option. There's no middle ground, okay? The only middle ground really, and this is super, super rare, is if you sell a 640 put and Meta is at $639.99 on that Friday of expiration, then yes, it's going to be around a 50 delta. There's a 50-ish% chance of that happening. Delta is also really affected by volatility. When volatility increases, out of the money deltas increase and in the money deltas decrease. So everything moves towards 0.5. This is why during market panics, even really far out of the money put options can have a surprisingly high delta because investors are panicking, they're scared, and there's more possibilities of lots of volatility. So anything can happen. And if anything can happen, then the deltas become around 0.5. It's hey, maybe this will happen, maybe it won't. So there's no real conclusive delta, and it actually increases delta for out of the money options because those options may become in the money due to volatility. Later on in this course, I'm also going to give you a free gift and a very interesting analysis when we get into our live trading. I'm going to be looking at some of the implied volatility factors as well as other factors of the option chain that are going to help me make decisions on the trades that I'm going to place. And again, I hope I don't let you down. My goal is to collect $5,000 worth of premium in that live trading session. All right, now let's dig a little bit deeper and talk about what you need to be aware of when you're selling put options. Selling put options can feel like free money, and it's really good. In a way, it is pretty much free money. But of course, there's nothing really free in life. There is some risk that you're taking. And anyone who tells you that this is risk-free is lying. A sell put option can go against you because the stock can fall. But again, if it falls, you have to just understand your positioning. You have to understand where are you right now, because a stock can fall down and a stockholder will lose a lot of money. The sell put will also lose some money. However, it will have some more cushion versus a stock investor. The biggest risk is really assignment on a falling stock. If a stock ends up crashing, you will get assigned and your assignment price will be a lot higher than the current price of the stock. If you sell a put on a stock at say $100 strike price and that stock drops down to $70 and you're assigned, now you own a $70 stock, but your cost basis, your average cost is $100. So even with the premium collected, let's say you collected $5, your average cost is going to be $95 while the stock is sitting at 70. What do you do in that case? Well, this is where the stock selection process comes into play because stock selection is everything. Option strategies are not that difficult. Once you get through this course, which is not that long, you'll understand selling puts better than almost everyone else out there. But stock selecting, this is the secret sauce. This is a really important factor because you can be great at options, but if you select the wrong stock, you will not be the most profitable trader. So you should only sell puts on stocks that you genuinely believe in, that you have done research on, that you find a good support level at. And I'm going to be showing you that in the live trading portion. I'm going to be looking at support. And I was looking at Meta. So that's going to be one of the trades that we're going to be looking at, as well as some cheaper stocks. Because if you have a smaller portfolio and you're a beginner, I'm going to be looking at some stocks that are going to be under $15 per share as well. So there's going to be some really good knowledge and actionable insights later on. Also, keep in mind, selling a put option feels amazing, but there's still opportunity cost because you are tying up capital, okay? When you sell a put option, I sell cash secured puts, meaning I have the cash available if assignment were to take place. So when you sell a put option, your cash is tied up as collateral. If you sell a $300 put option on Google, that is $30,000 that is locked up for 1 month. It's locked up. You can't do anything with that capital. It is being used as cash secured money that may get assigned for that put option, right? So you can't use that capital for anything else, which is why it is an opportunity cost. If another stock drops, say 20% or 10%, and you really want to sell some put options, well, too bad, your cash is committed, it is tied up. So make sure that you don't have any commitment issues, all right? And jokes aside, if you have committed the capital, from that point, you just need to make a decision. Does it make sense to close your trade and deploy that capital where it's more efficient, or have that capital stay in one spot? That's going to be a question that we'll answer later on in this course. Your account size does affect your strike selection as well. With a smaller account, you might need to make more aggressive plays. You'll also have to go for cheaper stocks that may be less than $20 per share or $10 per share. With a larger account, you can afford a lot more conservative plays and go for bigger stocks. Maybe that's Tesla or Meta. Those stocks are going to be a lot more expensive. If you have $10,000, you're not going to be able to really sell a put option for a stock that's worth $30,000. You're going to have to position size accordingly. Market conditions should influence your strike prices as well. In a raging bull market, in a high momentum market, you can sell put options a lot closer to in the money, right? Or at the money. You can sell put options that are closer to the money because they're not going to really expire in the money anyways. Let me show you an example right now on selling put options that are a higher delta because of a bull trend.
All right, guys, let's talk about high delta put options, because if we're in a good market, right, and if everything's going well, like you can see some of my positions here, that had done well, you can definitely go for a lot higher on the delta. So for example, let's say that a stock like Palantir has done pretty well, right? So Palantir is currently sitting at 182. Over the last 3 months, the stock is up, right? Although there's been a lot of volatility. However, let's just say that you want to get a sign, right? You want to get a sign for anywhere around like 175 because there's like a huge recovery, right? So like if you go right here all the way to the bottom, like that's 154. That's like probably just way, way oversold territory, right? Back in like November 2025. But basically, let's just say that you want to get in at 180, 175. Then it's completely okay if I go to trade options here to go for a lot higher on the delta. Because again, if you want to get assigned, then you don't really have to abide by the sweet spot rule of like 30 delta. So I talk about 30 delta. You don't really have to actually like abide by that. I want to get assigned anyway. So like if I go here, this is a 36 delta. So pretty close to 30. 180 though is a 40 delta. And this would be completely okay. The reason why it'd be completely okay is because if you want to get in at, say, 170, well, actually, you're collecting premium here of $16, right? Option premium is $16.15. So your actual like break even, you can see on the screen, is like 163.75. You can definitely go higher on the delta, and that's not a problem at all. If you sell higher delta, that just means that there's a higher chance of getting assigned.
In a choppy or bear market, give yourself more cushion. Okay, I just showed you an example of giving yourself less cushion, but when volatility is higher, give yourself more cushion. When the VIX is specifically high, the VIX is a fear gauge on Wall Street. If it's above 20, I will automatically move my strikes a lot lower. I'll go 5% further out of the money, and I'll go for deltas that are lower. My exact process is that I pull up a chart of a stock, I identify where I want to own it, I check the technical support levels, and I calculate premium as a percentage of strike price. And then I adjust based on my market conditions. It really just takes 30 seconds once you've done it. One quick tip for you is that I never sell put options that expire right after earnings unless I'm specifically playing volatility crush and I understand the risk. Because oftentimes what happens is that the option pricing will be elevated, but it's elevated for a good reason. Because many times a stock could have a very volatile reaction. So if your goal is to acquire the stock for a cheaper price, that's good. But earnings can be a very difficult period because sometimes stocks can come crashing down 15 or 20%. It's really just difficult to protect yourself in general with any earnings. So with that being said, market crashes also, of course, affect puts simultaneously, right? There is an impact whenever the market makes a big move, whether it's through earnings or news or just regularly through a market crash. In March 2020, everything dropped 30%. It didn't matter if you had diversification across different stocks. Every put was in the money. This is why position sizing and cash reserves are crucial. You need to survive crashes to thrive in the recovery. And in bull markets, of course, it's easy to make money. And in neutral markets, sell puts are really actually excelling because when a neutral market is happening and the stock market is just going sideways, selling puts is actually beautiful. Puts can do actually pretty well in crashes because they're not going to do well only compared to cash. If you have cash and you predicted the market crash, congratulations, you predicted the market crash. But there's a joke that's like, Michael Burry, the famous short seller, he's predicted about 27 of the last 3 crashes, right? I always joke around when, clients tell me, oh, Michael Burry is short and this person is short. I'm like, that person is always a bear. He's been short for years, man. He's like 27 for 3. He's predicted 27 crashes and 3 happened. Yeah, he's always a bear. So of course, when the crash happens, of course, he's been a bear. So of course, he's right. But the other 24 times, he hasn't been right? So a sell put is actually going to be very good unless you're trying to time the market, which if you're a beginner, if you still believe in that, just subscribe, watch more of my videos. It's really not possible to time the market. Nobody can consistently do that over any long period of time. But if the market is super, super bullish, then you should watch one of my leap videos and just use leap options, right? That is a good strategy, but again, it cannot be the majority of your portfolio. Now, let's move over into assignment risk, okay? So assignment risk is something that a lot of people are kind of afraid of. They're like, well, what is my chance of getting assigned early? Which shouldn't really be something that you're afraid of because you have a cash secured put, you have the cash to do so. But I still want you to understand assignment risk. Early assignment is very, very rare, but it's possible. American style options can be exercised at any time, right? You can exercise them. I don't recommend exercising. It doesn't make sense because when you exercise an option, you basically give away all the time value of that option. That's basically what happens very rarely. It does not happen very often that you will get assigned early through exercising. Nobody really does that unless the option has a very high delta and a very small amount of time left. Maybe someone will exercise, but that's when the delta is toward that 80 plus range. But if you have sold a put option that's deep in the money and has very little time left, well, maybe the holder will exercise. If they do exercise, they're kind of doing you a favor. They're assigning the stock to you earlier than you would have gotten assigned. But just take my word for it. If they exercise early on you on a sell put, that's a good thing. That's literally a good thing because they're giving you the stock sooner than you would have, and they have foregone the time value of that option. It's very, very rare that happens. It usually only happens when there's maybe very little time left and there's like a dividend date, okay? So sometimes they may exercise because of dividends. Dividends can make an option be more or less attractive, but dividends are usually a very small portion of the income that is made through option trading and through stock trading. So dividends is not really a factor that I personally do a lot of research or pay a lot of attention to. Now, there are times when selling puts is just really a bad idea. And that is when the stock is in a clear downtrend with lower highs, lower lows, and that's a bad trend. When you see a falling knife, yes, it can be interesting, but typically you really want to look out for better factors. And one of them is a 52-week low. That's more of a deciding factor. As long as the company has not fundamentally become a weaker company, and that 52-week low is just due to market forces. Now, when a company has deteriorating fundamentals, you really don't want to touch that thing, right? You don't want to come close to what's the saying, like a 10-foot pole. You don't want to have a 10-foot pole near that thing because it's toxic, it's bad. When it has deteriorating fundamentals, you're just trying to trade and kind of one up someone who is like short-term trading, right? I'm not into that at all. When the market is in free fall, just wait for some stability, okay? Wait for stability. Selling puts is a great strategy to use in all market environments, but if there's a drastic fall, just wait for a little bit more stability, okay? I will tell you though, and as you saw during, the volatility section of this course, it's a good thing to sell puts into volatility. Just don't fully unload all of your capital when there's volatility, right? If you have, 50K cash, you see the first sign of volatility, you're like 50K right now. No, just go week by week, right? This is even advice that I told my parents. My mom had a little bit of capital. She's like, what do I do with it? I'm nervous to invest it into Tesla, etc. I said, look, buy a little bit of Tesla this week, invest 10K. Next week, go 10K. Then next week, go another 10K. Spread your money around. That's what I learned at Goldman Sachs. When clients would come in with $65 million and they're the CEO of some tech company in Silicon Valley, the financial advisor who I was working with, right? I was in the financial advising department working with those, chartered financial analysts and those advisors that have big clients. They would say, listen, you got $65 million. We're going to put $5 million into the market every single week over 13 weeks, right? 13 times 5 is 65. So they would do it over a period of time, okay, regardless, even if there was not any volatility in the market. So again, when the market is in free fall, wait for stability. When volatility is extremely low, well, that's also bad because then premiums are low. So your risk to reward ratio is also terrible. So you're looking for the average. You're looking for average times in the market where there's some volatility. That's why I don't get people. They're like, I don't want any volatility. It's like, no, volatility is a good thing for an option trader. It's a great thing. Higher volatility means there's higher premium. Higher premium means that you make more money selling options. So you want volatility, just don't want extreme forms of volatility, okay? So here's also a specific example when not to sell puts. Let's say that Boeing stock is at $200 after falling from $400. Let's say the stock ended up crashing. It looks really, really cheap and the premium is super high. Well, sometimes when something seems too good to be true and it doesn't smell right, it's sometimes just not worth it, okay? There's a saying, I speak Russian, there's like a saying, it's like there's free cheese for the mouse, right? In the mouse trap. When something's too good to be true, be wary, okay? So there's ongoing investigations or plane issues in Boeing's case, right? In massive uncertainty, it's just not really a good idea to jump into a stock that is under so much scrutiny, especially governmental scrutiny, political scrutiny. All that is just better just to not really be in. I'm not really into the politics or anything like that. All right, now let's discuss risk management when selling put options. I love risk management. I used to have a risk management job when I was working on Wall Street, so I know a lot about managing risk, proper position sizing, and protecting yourself. So risk management is specifically what separates successful put sellers from the guys that full-blown just blow their account completely and lose all their money. The difference is really risk management. It's not like one person is better than the other, it's just one person is more smart about managing the risk. you can teach yourself how to manage risk. That's the good part. So I'm about to teach you right now. You can have the best strategy in the world, but without proper risk management, literally one bad month will wipe out all your gains. So it's important, obviously, the age-old adage is to have diversification, right? But what does that really mean? First of all, let's focus on position sizing. Position sizing is the foundation of risk management. Never, and I mean never, ever put more than 10, I was gonna say 5, but it depends, okay? 5% on a riskier bet, such as more of a leap option or something like that, or buying options. But when it comes to selling put options, 10% is fine. You can have 10% per position. Now, I personally break rules, and sometimes I go as high as 15 or 20% if I'm trading a good quality stock, say Nvidia, Palantir, SoFi. These are the stocks that I allow to basically break some rules, but generally, especially if you're newer, you should just have 10 stocks, 10% each, or even 15 stocks. Some of them are 10%, and some of them are going to be, of course, less than 10%. If you have a $100,000 portfolio, that means that no single position is going to have about $10,000 of your buying power, unless it's, of course, one of those big stocks, again. So this might seem overly conservative, but honestly, it'll save you a ton of money, because oftentimes, especially for beginners, they get overconfident. I myself, sometimes I get overconfident and I put a little bit too much money in one single trade. It really hasn't happened to me lately, but it can happen. So even if you're an expert or a pro, pros still make mistakes. So just stick to these rules. No matter how overconfident you get, and no matter how many stories you talk with your friends or people that quote unquote experts, and they say, oh, this stock is going to be the next Nvidia or the next Tesla or the next Palantir or the next Google, be careful. Just stick to having a proper position size and not going too heavy into any one position. And that's why a 10% position really matters a lot. If a position goes really badly wrong and it drops 50%, then a 50% drop on a 10% position is a 5% drop in your portfolio, which is already a pretty big drop, right? Dropping 5% is a lot of money, especially if you're in the six-figure range. So it's very important to keep those position sizes small. And if it ends up going down, one of the best ideas that you can use is simply not getting emotionally attached to it. It's okay. Stocks go down. If it's a high quality company, going back to stock selection, if it's a stock that you selected that has a bright future, has good cash flow, has good strong business, has strong growth, it just has a little bit bad of a period, it's okay. Again, if it's not a massive position, if you look at it individually, you're going to feel hurt, right? It's like, oh, I'm down a lot. But as an overall balance of your portfolio, because other stocks will be going up and other positions will be doing well, your entire portfolio is still going to be fine, even if one position is not doing super well. For me, I'd rather make $15,000 a month consistently, safely, and passively, and see that every single month, right? 15K, maybe 15.5K, 16K, versus making 35K one month and then 5K the other month. Another month you're up 10K and then you're down 2K and then you're up 48K. I'd rather just get a consistent 15K, 15K, 16K in that range, 14 to 16K, and it's just very little fluctuation. And that is pretty much possible with selling put options, especially if you have diversification. You can really grow your portfolio steadily and build wealth without having too much volatility with this strategy if you have 10 to 15 sell put positions open. Now, I'm going to tell you one more thing. It's not only important to have proper position sizing, because that's one thing, right? But it's no good if you have 10% of your money in Nvidia, 10% of your money in Netflix, 10% of your money in AMD, 10% of your money in Intel. You see where I'm going there? Yeah, I kind of figured. You're pretty smart, right? I hope that you understood what I just did there, right? Intel, AMD, Netflix, and Nvidia, these four stocks, what do they have in common? They're all like chip stocks. They're all in tech, right? So it's no good to have 10% in one position and then have different positions if they're all similar positions, right? So that's why I've made some videos on the YouTube channel about SPY, right? I've sold put options on SPY, and that's an S&P 500 index fund, has 500 stocks within it, the 500 biggest stocks within the United States. And of course, the technology companies do make up a large part of the S&P 500. But that's why you'll see later on when we do some trading, I'm going to include some more consumer stocks, I'm going to have an airline stock. I plan to trade some airlines today in our trading session. But you want to diversify across sectors. There's consumer discretionary, and there's 9. I think there's a 10th sector now. I think they added real estate. It was
back when I was in college, they added real estate. So I think there's 10 sectors. Consumer discretionary sector, okay, that's your McDonald's and Nike and things that is discretionary spending, right? Things that you might want to buy, but you don't have to buy if times get tough. A consumer staples would be something like a Procter and Gamble, which would sell toothpaste and toilet paper. Real estate is one sector. There's materials. There's your Caterpillar, right? CAT is the ticker symbol, Caterpillar. They have machinery. There's materials. There's energy. There's healthcare, such as your Johnson and Johnsons and your Pfizers and those type of companies. So the healthcare side. There's tech, of course, which we already mentioned. And then there's industrials, so airlines would count as an industrial, and so on. And there's financials like your banks. So you want to have diversification across sectors, not just diversification in the positions specifically, but in the sectors themselves. So don't just put 5 positions on tech stocks and you call it diversification. It's like, my friend, that's not diversification. You want to actually be diversified. So when tech sells off, everything is correlated, okay? So if you sell puts on just tech companies, they're all correlated. So everything's gonna go down in a similar fashion, right? So if Netflix is down 10% in 2 weeks, I can bet that likely Nvidia is probably down thereabouts as well. If Nvidia is down, AMD is very correlated to Nvidia. In fact, I can show you what correlation looks like. Let's talk about an example of 2 stocks and how if they're very correlated, it doesn't really make that much sense to trade both. So I'm gonna go to Nvidia right now because Nvidia has a very correlated stock and it's called AMD. So if I open up Nvidia right here, I'm gonna go to the chart feature of Yahoo Finance. Correlation is something that I really like. I studied data analytics back in college. And for me, just understanding the relationship between 2 factors, which is a correlation, is super helpful, right? It tells you a lot. Now, correlation does not mean causation. So one interesting example that I was learning back in college was essentially the relationship between kids drowning in a pool and ice cream sales. So these are 2 crazy things, right? But they're very correlated. However, correlation does not equal causation because, for example, there is more drownings in a pool because it's summer, and in the summer, more people go to swim at the pool, right? So you see how there's like a third variable that is creating the correlation between kids in pools having accidents versus ice cream sales, because people also eat more ice cream when the weather is warmer, which also happens in the summer. So there's an underlying variable there, which is the weather. So that was something really interesting. But in stocks, it's usually like correlation is a pretty good thing to look at. So if I go to chart right here and I go to comparison and then I go to AMD, now I'm going to get rid of Bollinger Band because Bollinger Band is not something that we need right now. So I'll get rid of moving average and Bollinger Band so we can just see the stock. Okay, so you can see here AMD has had a lot crazier of a return. And maybe the correlation has not been as close in the last 3 months. But if I go to the last 1 year, you can see that there is a pretty close relationship except for recently. So if I go to indicators, and then I'm going to find, so let me get rid of RSI and volume. We don't need either of those. So now we have a really clean chart. Let's go to correlation. I can also type it in here. All right, so now you can see the correlation here, 14 days, meaning when one stock goes up, how much does the other stock go up on average? You can also think about correlation in terms of if a pretty big company, let's say Microsoft, moves into your neighborhood of, let's say you're in Texas, right? So if Microsoft brings a headquarters to Texas, then the correlation of income that Microsoft makes will also be directly proportional to how many more jobs will be created, right? So when a company grows, it creates more jobs. So if a company triples, it's probably going to about triple its workforce as well, right? So when one thing triples, does the other thing triple more or less, right? So here, AMD has been very correlated. You can see that 90 correlation, 93 correlation, 99 correlation, meaning that usually they go up together. You can even see how closely these 2 things are related. So that's why it's almost literally silly for you to have AMD and Nvidia in huge quantities in your portfolio. It doesn't make any sense because look, from April 2025, right, the stocks literally went up the same exact amount. Like they were up 34% together. Like you can see how they're basically the same thing. You're making a bet on 2 twins, right? So that's correlation, and correlation is super important because correlation also helps you manage risk. Imagine if you have 10 stocks that all do this, right? They're all correlated. Then obviously when it goes down, all 10 stocks are going to go down. So you can build a portfolio of 30 stocks. If all 30 stocks are correlated, then it doesn't really matter. It would be like the equivalent of let's say that we could purchase people and that we can bet on other humans and we can get all of their earnings for their life. It would make sense for you to get one person in America, one person in China, one person in Middle East, one person in whatever, right? You would pick different countries to diversify, right? If you were looking to make, I don't know, 10% of each person's income, you can get 10 people, right? And you can take all of their lifetime earnings, right? Something that's not possible. But if you were to do that, you would pick different countries, right? Maybe you would weigh a lot heavier into America and you would pick 7 people in America. But if you're randomly selecting people from America, right, you could actually find someone in Minnesota who is on welfare and doesn't work at all. So that is your risk, right? So you might want to pick a place that has like a growing economy. Somewhere maybe you would pick UAE, right? United Arab Emirates, and you would pick something in Dubai, because then those people probably have a higher income if they can afford to live in Dubai. However, there's also like different classes in Dubai. So essentially you would want to pick different places, right? Recently though, you have seen here that there was some negative correlation. Negative correlation just means when one stock goes down, the other one goes up. And that could also be a competition thing. So when two companies are competing against each other and one wins a massive contract, then yeah, that can improve one business and then hurt another business. So here you can see some negative correlation, and we saw some negative correlation here as well. But you can see how not frequent negative correlation happens. Let's pick 2 other stocks. So I'm actually going to pick Robinhood and SoFi because I make that video on this YouTube channel pretty often. You guys really enjoy my analysis on Robinhood and SoFi. So let's go to Robinhood and let's go to the chart. And I'm not sure myself. My guess is that Robinhood and SoFi are also very correlated, maybe like 70 correlation over 21 days. Okay. So right now it's comparing AMD. So I guess let's take a look at AMD and then we'll look at SoFi. Okay, let's go to 3 months. Not super strong, but strong correlation, 0.6. Okay, you can see how they do move similar, but sometimes, of course, SoFi or Robinhood will have better performance in certain periods. But it's super funny how even over 3 months, these 2 stocks have the same exact return. Like literally the same. And that's why I put them in the same videos, is because these 2 stocks are like head to head. They're both innovating, they're both doing good things, and they're both treated the same by investors, by the large mass of people who are investing in the stock market. These 2 stocks have been super correlated, right? It's funny because we see a 0.6 correlation, but you would think there's even higher correlation given how they just have the same exact return over 3 months. Over 6 months, there's a big difference. There's a very big difference of return. So 93%. I believe this is, yes, SoFi had a higher return. But that doesn't mean that one stock is better than the other. If I were using a selling push strategy, I would definitely have both of these. I would absolutely have SoFi and Robinhood. All right, so as you just saw there was a lot of correlation between NVIDIA and AMD. It's almost like investing in the same company. There are 2 different companies, but the stock market treats it really as one company. When one goes up, the other goes up as well. So you want to really spread across different industries. Maybe one tech company, one financial, one consumer, one healthcare, one industrial company. So when one sector is struggling and it's going down, another sector may not be struggling as much. One example is actually utilities. So there's a lot of utility companies like water and gas companies. They're very stable. So oftentimes they pay a higher dividend, but they're not really going down that much. And these actually provide a safe haven for investors, and they exhibit very low volatile returns, very low volatility. So when one sector is struggling, others might actually be thriving. That's one way to diversify. But now let me talk about another diversification. So I told you I have a gift for you later on when to close a sell put position and redeploy that capital. That's going to be later, but I wanted to give you one gift now that I've not really talked about on YouTube, which is time diversification. It's a very interesting concept because there's position diversification, there's position sizing diversification, there's sector diversification. Time diversification is something that I specifically have only really focused on with more of my private clients and my private students that do one-on-one coaching with me, but now I'm going to be revealing it to you, okay? Time diversification is so underappreciated. And oftentimes we have volatile events in the stock market where in a specific period, a lot can happen. When a lot happens in a small period of time, that can be very tumultuous times where investors make more mistakes. Because, for example, even I myself back in 2025 in April, when the market hit the bottom of April on April 8th, okay, I ended up losing actually a significant amount of money, and I actually cut some of my losses on the bottom. Okay, I actually mistimed the market. So it's because nobody can predict the market, And I did have a little bit more positions that I was not super comfortable with. So I ended up losing. It wasn't a massive amount of money in comparison to my portfolio size, multiple seven figures. I lost like 100K, okay, which is a massive amount. I get it. That does not grow on trees. I'm not happy about it. It sucks, okay? But 100K versus my portfolio at the time, which was around 4 million, was a 2.5% loss in my portfolio, which is pretty significant, okay? I could have actually done a lot better, right? Because I had a lot of positions that were expiring on one expiration date. Time diversification would have saved me probably $50,000. I would have saved $50,000 because I would not have closed out and sold some of the positions at a pretty bad price, okay? So what is time diversification? Time diversification is simply this. This is why I encourage you to sell multiple expiration dates, because time diversification is selling a weekly option, a 2-week option, a 3-week option, and up to really, I would say 3 months. Okay, at 3 months, that's like long enough option where most people are not even patient enough. They're like, hey, I just want to really see what's going to happen in a short amount of time. They don't want to sell a leap put option, although that is another strategy that we can discuss in this course. For now, at this point in time, typically I sell monthly options, right? But going a little bit shorter is time diversification. Going a little bit longer than that month is also time diversification. So if one bad event happens, you don't have one single expiration date that really impacts a lot of your options, and then you're not feeling comfortable. I myself was not feeling comfortable, okay? So it can be very important for you to have time diversification across different expiration dates from 1 week, which is, I don't recommend a lot of that, up to really the 3-month mark. And that is going to create a staggering amount of more safety in your portfolio. This way, you're not really making all of your decisions on one single day. So you don't have to really make those emotional decisions. And I'm telling you right now, you're probably thinking, Henry, can you talk a little bit more about the math? We're gonna get to the math. Can you talk a little bit more about managing positions, opening these positions, closing these positions? I'm gonna get there. But if you skip this part, you're not gonna understand the foundation of option trading. This way, you're not making all your decisions in one day when you might be emotional or when the market might be at an extreme. Now, let's also talk about cash reserves. These are mandatory. At a very advanced level, I actually teach my one-on-one students to do the opposite of having cash. We actually use margin, but I'm really not going to discuss that on YouTube. That's a super more advanced topic. But for a majority of people, it is very smart to have some cash because especially as a beginner, you're not going to be super comfortable getting 100% of your money in the market, yet alone using margin, right? There's a safe way to use margin. There's also being 100% invested is something completely okay. A lot of people might think that's crazy. There's actually a research study coming out of Yale Economics. I remember clearly when I was working at Goldman Sachs, I was doing a lot of research. And this article specifically talked about having 110% invested in the market as a very smart strategy. Because the market goes up over the long period of time, not being invested more than 100% in the market actually ends up costing you money on average, because on average, the market is going up 10% or to 12% on the S&P 500, right? I've generated a lot more than that. Not too much more, because selling puts in itself, it is the gateway to some other higher earning strategies. Of course, in a single month, we don't know what's going to happen. It's not the smartest idea to gamble in a month. But over a long period of time, it makes sense to not have that much cash. But as a beginner, if you're watching this, you're like, I'm new, Henry. I don't know perfectly what I'm doing yet. I don't know how to get in yet. I don't know my deltas. I haven't traded a whole lot. I've made some mistakes in the past. I'm a bit nervous. That's fine. You don't have to be that advanced level yet. We all have to start somewhere. So cash is good. Cash reserves are fine because when the market does pull back, you can deploy cash, okay? So I tell beginners, let's keep a lot of cash on the side. Maybe it's 20%, okay? Until you get very comfortable, it's good to have cash. This also serves two purposes. First is dry powder for opportunity. So when the market panics and premiums go up, again, that helps a put seller. It is good for the put seller when the volatility is elevated. Second, it's a psychological cushion. So knowing that you have reserves helps you stay chill during drawdowns, okay? Because some of your portfolio is going down, but rather than being 100% invested and being like, oh, I'm losing so much money, I don't have any cash, part of you is like, great, it's falling down, I have cash to put to work, okay? So in the short term, in the beginning of your investing journey, especially in your first year, having cash is fine, okay? Also, if you're in your first year and you have some capital, there's a huge shortcut, and that's mentoring, okay? I'm a mentor, I'm a coach. Yes, I sell mentoring and coaching, and I have a program. However, I have had mentors in every area of my life, right? Whether it's the gym, whether it's getting financially smart. I went to college. I spent 5 years actually. I had many jobs and many mentors, and it was very helpful. Learning from someone else is the cheat code and shortcut. So again, I encourage you, if you want help, I love working with people. So I love helping people. I love teaching others what has made me financially free. So if you're interested in that, click the first link in the description and learn more about the coaching program. It's completely free to learn more. We'll give you all the details and see if it's the right fit for both of us. All right, so let's talk about stop loss. Stop losses are interesting. Stop losses on puts, they're tricky. So how do they actually work? Okay, sometimes it's necessary, sometimes it's not. I don't personally use hard stop losses because they can be pretty volatile. Options move a lot because they're a derivative of the stock. So when the stock moves, a couple percent, the option can move a lot more. So if you end up doing a stop loss on a sell put option intraday, in the middle of the day, especially because sometimes there's not a whole lot of liquidity, the bid and ask, I don't want to get complicated here, but it could end up doing more harm than good. You can end up not doing too well when you end up doing a stop loss because you get out of a position at the bottom of the day, you check your portfolio, you say, I got out of this position, but this position is not even low anymore. It has recovered. So what happened here? Well, you got stopped out in not a good way because your stop loss ended up executing and it didn't really execute at a good price. So I don't personally really recommend stop losses. What I do recommend is having a mental stop. Okay, so if it goes to a certain strike price, at that point, you may want to close out that trade for a loss, or you might want to adjust that trade. We'll talk about adjusting a little bit later after we get through all the foundation, right? Again, I'm building you up. I'm building you up in the shortest amount of time possible to give you a strong foundation. Then we're going to layer your knowledge up, and then I'm going to start mentioning and really advanced things. You're going to be like, got it. That's cool. Let's talk about my risk management framework and practice. With a $100,000 portfolio, $20,000 of cash reserve is totally okay if you're a beginner. $80,000 will be available for puts, okay? Some of that $80,000, you can do some other strategies. I talk about other strategies on this channel. Please check out my playlist. I have a 6-hour free course. Talk about other strategies there, but for the most part, you can use a lot of your capital for selling puts. It's the best, it's the safest strategy anyways. So you can basically, with 80 grand, for example, you can have 16 positions, $5,000 each. You can have 12 positions. Some of them are going to be a little bit bigger, with others being a little bit smaller, right? So spread across at least 5 sectors, staggered expiration days, right? So 1 week and 3 weeks and 4 weeks and 2 months. You want to have a combination of that, different time expiries, time diversification. And also reassess any of your positions if they're down like 50%. Okay, so if you sold a put option for, say, $5 worth of premium and now it's down 50% at $750, just look at it. You don't have to close it. Just say, hey, position is down. Why is it down? Has the stock changed? Has any of the fundamentals changed? If no, fine. If yes, I'm going to think about closing that position. All right, guys, which stocks should you pick for selling put options? This is the $1 million question. The most important part of the course, in my opinion. Stock selection, man, it's everything. If you can't select stocks, you are nothing. It's like discipline. Going to the gym one day, cool, that's fine. Going to the gym every day, that's discipline. Stock selection, it's discipline to pay attention to these stocks, which ones are good, which ones are buys, which ones are sells. How do I determine that? What do I look for in a new opportunity? Man, let's talk about it. You can nail the strike price, you can nail the expiration dates, you can nail the timing, but if you pick the wrong stock, you're gonna lose money every single time. So here's what I look for. The first is the fundamental rule. Only sell puts on stocks you'd be happy to own at that strike price. That strike price better mean that stock has a good PE ratio, has a good price to sales ratio, has a good valuation, does not have massive short interest. Okay, short interest is an issue. Okay, does not have too much debt. The company has too much debt, then that's risky. Also, that the company is profitable, because a company that is pre-cash flow, one of them is ACHR, Archer Aviation is a company that I've been looking into for some time. And the only reason I made an exception for that stock is because they had a lot of good relationships with government, suppliers, and logistics. So when I looked at a company like Archer, I was like, okay, fine. I see some Palantir-like behavior, some Palantir-like synergies here with government. So that was an exception I made. But typically when a company is pre-revenue, absolutely no. Same thing with biotech stocks or anything that requires some type of FDA approval or some massive risk. No. When you sell a put, you really are buying the potential earnings of the company forever. You should look at it as buying a business. You're buying a business, so try to analyze the business. Okay, easier said than done. Analysts on Wall Street do this all day. In my program, I do go over more details into analyzing a stock and the fundamentals of it, but let me tell you some basics. First of all, quality companies with real businesses are essential. I want companies with actual revenue, like I said, positive cash flow. You can just find that there's the three statements. There's the income statement, balance sheet, cash flow statement. These are the three statements. I did take some accounting classes back in college. I'm not an accounting expert by no means, but I look at these numbers. I want to make sure that they're going up. For example, when I was looking at SoFi recently, they had a quarter that was almost $1 billion. When I look at their customer growth, it's growing exponentially. When I look at, I graduated business school, so for me, I look at businesses, right? So when I invest in stocks, I'm really investing in businesses. I'm a businessman, okay? I don't call myself really a trader. I guess I'm more of an investor businessman. So I try to understand, what am I investing in? So when you're investing in trading, you're really trading businesses. That's what stocks are. They're businesses, right? So I want to understand, what is the cash flow? How is this business growing? So when I look at a company like SoFi, I even go as deep as understanding, what is the customer acquisition of this business? How much does it cost to acquire a customer? Because customers don't come from the sky, right? Businesses need to acquire customers. SoFi does marketing, whether it's through sponsorships or SEO content marketing, right, on Google and stuff like that. I've determined through my research that it's $50 to acquire a customer, okay? And then the long-term value or the lifetime value of that customer is $1,000, okay? That's a good, strong business with actual revenue, positive cash flow, profits, great marketing, great customer experience, etc., right? And I'm not promoting the stock, that's just an example, right? There's other great businesses. There's Robinhood is a great business. Obviously, Amazon's a great business, right? Even companies like Uber are great businesses that obviously made a lot of money. Airbnb, decent business, right? There's American Airlines, although they have a ton of debt. Airlines are a tough business because they have a lot of debt. They have other benefits, right? I can't even fit in this course how much we can talk about fundamentals of a business. This is what analysts do full time. This is part of what I do in my community. Is my job is to save people time. Which companies you sell puts on? I'm doing that research. I'm picking which companies have competitive advantages. That's really important to me as well. Does this company have a competitive advantage? Can they be beat? Can they be disrupted? These are all the factors I look for. And it doesn't take a lot of time. I read a lot. I spend a lot of time reading, okay? Now, that's like some of the fundamental stuff. Let's also talk about market cap. Market cap matters a lot for stability. If you think that you're going to be selling put options on a stock that has a $1 billion market cap or sub 1 billion, you're out of your mind. That's a completely bad idea, right? You want to sell usually on companies that have a 10 billion market cap or higher because those are more stable companies. Those are considered large cap stocks. Large cap stocks don't disappear overnight. You're not going to really disrupt Netflix overnight. Definitely not going to disrupt Apple and Amazon and all these big cap stocks. When it's hard to disrupt a business, that's a business that's probably not going to go down that much. And if it's not going to go down that much, it makes it a safe put selling candidate as long as it has a lot of these factors that I'm talking about, right? So let's also talk about something that's very important when it comes to risk management, which is portfolio sizes and appropriate stocks, right? Because if you have a $10,000 portfolio, you just can't really buy certain stocks, right? Like Costco, it's super expensive. I don't currently have it in my portfolio, but Costco's a great business, okay? Costco is a genius because they have razor thin margins. So when you buy goods at Costco, they make pretty much nothing. But there's a membership, right? So you have to pay a membership and they make a ton of money off of memberships, right? So they have a ton of recurring subscriptions. So Costco's kind of like a software business because they have recurring membership model and they make all of their money through that membership fee. The food and everything that they sell, it's almost like they're like Uber, where they're matching the demand of people that want a taxi or go somewhere with a driver who's willing to take someone somewhere. Costco's almost like that. They're logistically figuring out all the food and all the goods. Customers want those goods, but then they're selling it for like no margin, but they have a membership model, right? So that's something that I would look at for stability. But the point I'm at right now is you won't be able to afford that stock. And that's okay. If you don't have the money, I don't have a solution for you. You just don't have the money. So look for stocks that are a little bit cheaper. I look for stocks that are cheaper all the time. And I'll show you some more cheaper stocks in this video as well when I do some of my live trading. Now, let's focus on some quality names. Some quality names for me, by the way, I'll just tell you them right now. SoFi, American Airlines, I like HIMS because the strong marketing practices that they have. if you don't have that much capital, Snapchat's pretty good. It's under $10 per share. And there's several other names. Archer's also like under $8 per share or so. There's several names that you can definitely trade. But of course, having more capital, of course, helps you because it helps you diversify. Now, when you have a portfolio that's about $50,000 plus, the entire market just opens up. Everyone wants you at that point, right? You got Google, you got Tesla, you got Microsoft as well. So these are some of the best companies in the world where the premiums might be a little bit lower in terms of percentage-wise, but the quality is unmatched. So selling puts there, it's like, you can't even argue with me. Like, how could you go wrong selling a put option on Microsoft? Like, what do you have to say about that? Of course it's safe, right? Now, on the fundamental analysis for put sellers is pretty different from stock pickers. I'm not looking for the next Amazon, guys. A lot of people confuse me. I'm an option trading coach. I love helping people get results. I'm not spending all my time looking for the next Amazon. I'm probably, to be honest, I'm just not cocky enough. I don't think I'm going to find the next Amazon. I'm not going to. The thing is, I don't need to. The most boring businesses can make a lot of money, right? So the boring stuff, the more stable stuff is what I'm after. I'm looking for consistency as well as growth, okay? And it's a lot of big companies have a lot of growth. So I'm looking for companies that won't go bankrupt, that will probably be higher in a year, right? And it's not that difficult to know what's going to be higher in a year, okay? As long as the economy doesn't tank, right, which I can't control. It's out of my control what the stock market does, but it is in my control to pick a business that has a good value, right? That's going for good valuations. So my checklist again, positive free cash flow, high free cash flow as a percentage yield, okay? That's something that I go a little bit deeper in my program. Debt to equity ratio under 2. Revenue growth, even if it's slow, some revenue growth. Recently, Chipotle, they reported weak same-store sales. That's an issue. Weak same-store sales is an issue because that's saying that less customers are going to do business at that location. AK for Chipotle means less people are eating their burritos at that same location. They're opening up more stores, but some of those same stores are suffering a little bit with customer, not coming as much. So that's all the things that I'm really looking for. Same store sales growth, and if the business model is just conducive for scaling. Not all businesses can scale infinitely to the moon, right? Some can, some cannot. Some require heavy infrastructure. Some are software businesses, so they have unlimited scale, right? Let's talk about dividend stocks and mention them real quickly. Dividend stocks can be great for put selling. The dividend provides extra cushion if you do get assigned, right? So if you get assigned, I have a dividend paying stock. But if you don't get assigned, right, if you sell a put option, the dividend actually does hurt you because when a stock pays out a dividend, the stock's price typically drops by the dividend amount, right? So you have to be aware that a sell put might have a high premium, but it might also have a high premium because the people that are buying that put option, they know that when the stock has a high dividend, say AT&T, which yields I think like 6% annually, when they pay out a dividend, the stock drops by 1.5%. So if you're like, hey, this option looks really, really good, it might be because there's a big dividend payment, but typically that's not something to really be concerned about. And dividend paying stocks are also going to have a lot lower volatility, so they're usually not the most profitable. So I mentioned ETF like SPY in this video. I just want to point out that ETFs like SPY, QQQ, IWM, these ETFs are very strong. They're very good. So if you're someone that's just looking to retire and create safe income and you don't want to have single stocks and you're a beginner, it's okay to just sell put options on ETFs such as SPY. Another ETF that I personally like is IBIT, which is the Bitcoin ETF. It's good to have some of that in your portfolio as well. All right, now let's talk about why not all companies can scale infinitely to the moon, and some businesses are just built better for scaling. So I'm going to show you something really valuable in the statistics tab. I'm going to show you the profitability of Microsoft, and I'm going to compare it to a company that can't scale as well, which is Starbucks. Okay, so two big companies. Microsoft here has a PE ratio of 30. Forward PE ratio is what will the PE ratio be in 1 year if analyst estimates come true. So again, we'll put it up on the screen. If the stock price is $100, right? And then the PE ratio is 10, that just means that it's earning $10, $100 price divided by $10 worth of earning gets you a PE ratio of 10, okay? So that's what it means. So if next year the company starts to earn $20 in earnings per share and it's still worth $100, then it's going to be $100 divided by $20 in earnings. The new PE ratio will be 5. And that's why people who look at PE ratios and they say, for example, Palantir had a 600 PE ratio and that's bad and this company is overvalued, they completely do not know what they're talking about. This is a noob investor that only knows one metric. It's completely wrong. Looking at only PE ratio is like looking at your wife, and just because she has small hands, you say that's a bad person. It makes zero sense, right? You cannot judge a person's character based on their hand size. P ratio is like that. P ratio is good to look at, but if you only look at P ratio just by itself, it's pretty useless because companies can have extremely high PE ratios and they can go down by half, by 4 times, by 10 times. Tesla had 1,000 P ratio and the next year was 300. The next year was a lot less, right? So a P ratio can change drastically. And I just wanted to point that out because a lot of people mistaken a high P ratio for a bad stock. That could be furthest from the truth. In fact, oftentimes a company that is wildly growing in terms of revenue and has just become profitable will have the highest PE ratio. And that could be a really good thing for scaling a business. So Microsoft can scale the business easy because let me just show you their profit margin. So their gross profit is 202 billion. They're growing pretty quickly. They have a lot of cash. They actually do have some debt, but that's okay. Obviously, Microsoft can pay off their debt. That's not really an issue. But you want to look at profit margin, which is right here, 35%. So every time that Microsoft basically makes money, they're bringing 35% down as profit, okay? So that's really big profit. And that's what the difference between a software company that can scale a lot easier because most of Microsoft products are software like Windows, Office, Azure. So once the software is built, selling it to 1 million more users literally costs almost no money at all. And the margins are actually only expanding because the more sales there are, the more these sales will cover fixed cost. So your actual margin actually increases and scales even better with more sales, right? Now, that's not the case for something else like a Starbucks because Starbucks has much higher variable costs. That business cannot scale as efficiently because every new store or additional customer requires baristas, rent, ingredients, utilities, equipment. So the cost is not really directly going to be as scalable. And I'll show you that right now. So we're going to type in Starbucks here. Because they have a lot more employees, they actually make a lot less money per employee. There's some businesses out there that have like millions of dollars per employee. Google is one case. And then some other businesses like private content, websites, subscriptions to beautiful women that obviously are overpaid. Those type of companies, I'm not going to mention, can make $5 or $10 million per employee or like $50 million per employee. Fortunately or unfortunately, I'm not into that, but it's one of the most scalable businesses when you look at like more content. And that's why businesses such as Netflix, such as Google are so powerful. And then other businesses such as like a Starbucks is going to have a much harder time to really scale their business. So if I go to statistics right now, we will take a look that the 4P ratio is actually very similar to Microsoft. But if we go to profit margin, it's literally, instead of 35, it's literally like 5%. So super small margin that pretty much is very difficult to scale. Alrighty, let's now talk about timing the market. I don't try to time the market, but I do understand market cycles and I also understand technical analysis. Technical analysis is a very important tool that can help aid in stock selection, that can help you understand what strike price to sell a put option at. So let's go over several examples right now on technical analysis. This is probably one of the most important parts, especially if you're a beginner. I want to show you a current example of a stock that I'm going to analyze for you right now. And I'm also going to show you a little bit older of an example where I was 100% right, why I was right, the trade that I made, and how I profited from that trade. So let's go over 2 of these examples.
So let's do the technical analysis portion of this course right now. I'm going to be using 2 different stocks and I want to show you the key indicators that I use, and I want to keep it super simple and very beginner friendly for you to understand and analyze a stock properly using technical analysis. So check it out. SoFi right now trading for $12.70, and I want to go over the chart and just kind of tell you what has happened with the chart and then how I would analyze this if I wanted to make a decision whether to buy or sell or trade a specific option. So look, SoFi has traded as high as $18 per share. You can kind of see here very logically on the chart, back in January 2025, it reached a high, and that was the highest point in the past 6 months. So I'm looking at a 6-month period, and this is the best time frame to really use. If you go out really far in terms of date, then, that's like really, really old data. And if you use too short term, well, that can also, kind of skew the picture as well. And too short term data is also not as useful. So 6 months is the perfect amount of time to really analyze the charts. And by the way, when I was working at a hedge fund, the quant analyst who was incredibly smart, he was a genius, also said that 6-month time frame was what he used. So yeah, sticking to 6 months, you can see here that SoFi reached the high of $18 per share, and then has been basically on a bear trend along with the entire market in 2025. Unfortunately, been a lot of volatility, but you can kind of see here what's going on. It reached the high 18, and then it reached another kind of like peak here at about $17 per share. This is really interesting because you can essentially draw like a trend line here. So if I were to draw, there's a new version, by the way, of Yahoo Finance. But if you draw from like here to here, you can see that it's been very interesting and has actually predicted kind of like the downward pressure in the stock. You can see high 18, high 17, and then essentially we just hit another peak at $13 per share. Now, here's the interesting thing. Although this is a bear trend and has been bear trend, at some point you want to see where the stock can find support. You can actually see a pretty nice support here, a double bottom pattern. So a double bottom pattern is basically within a fairly short amount of time, a stock hits a bottom, tries to recover, hits a bottom again, and then investors say, hey, we really think that this is a bottom based on investor behavior and psychology. They think that the stock is low here, and there was heavy selling pressure. You can even see here by the volume, there was just very heavy red days. Like you can see multiple big red days of selling pressure. So the stock has basically have pretty good support here. And now we're back on the uptrend. So that's kind of like visually what you should be looking for. Aside from the visuals, you can now see that I'm using 3 different indicators. The first one is the Bollinger Band, hands down, the most important indicator that you can ever use in trading, period. Okay. The Bollinger Band essentially looks at what is normal and what is not normal. Okay. What range do we see the stock going? Okay. And the Bollinger Band is based off of statistics and math, some basic statistics and math. I won't go too deep into this course. It'll be a very long explanation. Let me give you this short and simple explanation. This Bollinger Band is using something called the bell curve. A bell curve kind of looks like this. Okay. You'll see it on the screen right now. Okay. And you can see that in the middle of the bell curve, about 68% of the data is within one standard deviation. Okay. What does that mean? Well, if you look here, the Bollinger Band, pretty simply said, it gives you some options. Yahoo Finance will give you a period. Go for 20 days. 20-day period just means like basically 20 trading days, which is like roughly 1 month. And the 2 standard deviations, this is what I'm explaining to you. 2 standard deviations, a 2-move standard deviation would be about 95% of the data on the bell curve, okay? And let me explain it to you a little bit more simply. As you can see the bell curve on the screen right now, the 0 standard deviation, or like the very center standard deviation, would basically be, let's say that you were a man, you are 5'10", and you have a son. Your son on a 0 standard deviation is going to also be about 5'10". Based on genetics, you'd be about 5'10". Now, let's say 1 standard deviation would be 6'1", and 2 standard deviations would be 6'4", right? So you can basically see how the Bollinger Band works for the stock right here. You can see that SoFi is trading within the Bollinger Band a majority of the time, and this is a 2 standard deviation Bollinger Band. And again, going back to the example, 2 standard deviations to the right would basically be if you're 5'10", your son is 6'4". 2 standard deviations to the left, okay, 1 standard deviation lower would be 3 inches lower than your height, so it would be 5'7", or 3 more inches lower would be 2 standard deviations, which would be 5'4". So you can see how, stock trading, it has a lot of applications very similar to life, for, in this example, human height. So at the top of the Bollinger Band, it would be, unusual on the top end, and the bottom of the Bollinger Band, it would be unusual on the bottom end, okay? So the 2 standard deviations here basically tells you that the stock should be trading within this level. If it's trading outside of this level, it would be as unusual as the height example I made. Also, you can do an income example. So the average income in the United States is $60,000, let's just say, right? And 1 standard deviation would be making $100,000. 2 standard deviations would be making $140,000. And then, you can also go on for more standard deviations. However, it doesn't really make sense. And let me show you an example why it doesn't really make sense. You can actually change the Bollinger Band to 3. What this would do is it would make your trading even safer. And you'll see why. So if I go to 3 right now and I click done, you can now see that this Bollinger Band has expanded. So it is telling you more unusual data. So, for SoFi to go up to $15 here in the next month, this would be very unusual based on the Bollinger Band. Or for it to fall down to like $8 per share, that would also be very unusual behavior. However, at 3 standard deviations, it's not that good because you're getting so unusual and you're getting so low risk that you're giving up a lot of the return. So I'm going to change this back to 2. And what this means essentially for you to review this course, if you sell put options, you should be selling closer to 9. However, this is just based off of the Bollinger Band. Let's talk about the other indicators and how to use them. Because the center of the Bollinger Band, for example, is 1140. And since SoFi is above, I would kind of go closer to that 1140. Now, this red line is the moving average. It's just saying, hey, if you take all the data for the past 50 days, I'm using a 50-day moving average. Some analysts, some traders, some investors like 60, some like 90, some like 30. I like just using 50. 50 is a good mix of really short-term and somewhat short-term and maybe some longer-term data. So using 50, I can pretty much make a better decision on SoFi that the 50-day moving average is hovering right around $12.20. So if I wanted to make a smart decision, and let's say that I wanted to sell a put option, I would sell it at about $12. Now there's multiple data points to support this. Middle of the Bollinger Band, 1140. Moving average, 1220. So, I'm getting an idea in a sense for, a good strike price to sell a put option. So here it would be $12. Now, the other indicator that I use is RSI. The RSI is basically very interesting for telling you the strength of momentum. So how strong is momentum of investor sentiment? So right here, you'll see that it's 55. 20 would be oversold and 80 would be overbought. 55 is right around the center. And my overall analysis of SoFi in this point of time, we have many examples throughout time as I'm making this long course. It's taken me months to make this course. The technical analysis here tells me that SoFi is somewhere in the middle of its Bollinger Band. It's not overbought or oversold. And based on the moving average, it's right around its moving average. Therefore, what I would be doing right now is I would pretty much put a short-term neutral price target on SoFi in the short term. And even it's a little bit more on the expensive side since it is, towards the top of its Bollinger Band. For this reason, the best strategy that, I would use right now and, have my Discord calls on Mondays and Wednesdays, and I do my coaching, and SoFi is something that I trade all the time. A very simple decision for me to make on SoFi, and what I will do when the market opens up today is I will just be selling a put option for the $12 strike and collecting income on SoFi and looking to generate cash flow and acquire shares of SoFi for lower than the current price. The current price is $12.70. If I sell a put option at 12, I'm getting a 70-cent discount and I'm going to get paid for basically nothing. I'm getting paid to buy a stock that I want to own. So that's why selling puts is a great strategy. And this is why, the Bollinger Band and the RSI and the moving average are the only really 3 indicators that I will use. And just for some comparison, just so you understand, there is so many different indicators and a majority of them are just complete BS. After working in the industry, I've seen some of the best people just using the simplest indicators, just really using simple strategies, simple indicators. And I believe that to be the best to scale, to retire, to generate the income that you're looking for in retirement. And just to have enough money to really live your life without having to work. And in retirement, if you want consistent cash flow, safe cash flow, reliable income stream, you really want to go for simplicity rather than too much complicated techniques, complicated indicators. I don't believe in any of that. I've done very well just sticking to the basics. And just so you can see the indicators, a lot of this stuff, I don't even know what it is. Like the awesome oscillator, the center of gravity, the Chalkin, money flow, the choppiness index, the Darvest box. I mean, a lot of this stuff, like you can see I'm scrolling here, the Keltner channel, a MACD can be useful, though I don't use it all the time. I mean, there's so many indicators and the majority of them you do not need whatsoever. So I'm going to save you a lot of time, a lot of hassle, and just tell you, keep it simple. And that is the best way to be profitable.
All right, guys, March of 2026, and I hope that you enjoyed the clip that was some time ago on SoFi when it was at $12 per share. And right now, SoFi is trading for just under $18 per share, and I want to analyze the technical analysis. So as you can see, the most important technical analysis indicator that I personally have been using for a very long time is the Bollinger Band. SoFi went on a pretty massive rise since 2025, and in 2026 it has been pretty rough waters. There's been some tariff concerns, an Iran situation, and more political stuff that has really impacted the market. Also, cryptocurrencies have been doing pretty bad, and because of cryptocurrency, multiple stocks that are in the fintech sector are down, such as SoFi and Robinhood. However, the long-term trend for SoFi has still been positive. And when I covered the stock, it was at 12, and now the stock is in the mid 17 range. But what you can see right here is a very important, pay attention to this, because this is really life-changing and game-changing stuff when you really understand the technicals, because most investors are misunderstanding this. They're making huge mistakes. And if you just understand the simple technical pattern, there is so much opportunity for you as an investor. Look, the stock went down, but it mainly did stay within the Bollinger Band. Yes, there was an overreaction in basically February 2026, and the stock ended up crashing down along with crypto. The crypto market crashed down, Robinhood stock crashed down, and many other even Mag 7 stocks ended up taking this nosedive. This was pretty unpredictable. But from here, it was predictable. It was very easily within the Bollinger Band, even above the Bollinger Band. The negative momentum was pretty obvious because the RSI also ended up reducing, but not below 20. That's very important. If RSI is below 20, that basically means the stock is oversold. But oftentimes there could be a sell-off, and if it doesn't go below 20, that could be an indicator or a sign. That's one of the pieces of my check notes that the stock can further fall lower. And here, SoFi ended up bottoming out around $18, and we are lower than $18 right now, but not significantly lower. And this actually presents a really big opportunity because there's a double bottom pattern here, and now SoFi is trying to go lower, but it's really not managing to do that after multiple weeks, about 2-3 week period right now, where the stock is flailing and not doing much. And that's okay. That just means that a lot of investors have sold off. You can see the crazy red volume here was very high, and then just many red days. Then again, pretty big red volume. And this to me tells that investors who are afraid of the stock, who have lost confidence in the stock, are getting out. But the fact of the matter is the insiders, so there's 3 insiders, Anthony Noto, Eric Schopenhauer, and another gentleman, forgetting his name at the moment. 2 gentlemen bought 5,000 worth of shares, and then Anthony Noto bought $1 million worth of shares. So insiders are buying, yet the stock is going down. They had the best quarter ever, over $1 billion in a quarter. So the business is doing phenomenal, yet the stock is moving in the opposite direction. So on a technical chart, it's really important to understand how low are we, okay? Is there double bottoms, which yes, there is. How is the volume looking like? And very simply, even after this massive pullback, what is the moving average? The moving average is sitting at $22. What is the bottom of the Bollinger Band? We're there. We're at the bottom. If I zoom in here, you really can't currently get that much lower. The chances of getting lower are very slim to none. Of course, anything is possible, and trading is risky, and options are risky, so you never really know, but probability-wise, the chances are fairly low. So when you see a stock coming down to its Bollinger Band, and the more I scroll in here, you can see we are at the bottom. That is a sign that there is going to likely be a bounce back to normal, and it's called mean reversion. A stock will typically come back to its mean, and that is true of biological organisms, of financial products, and many other things in life. Things bounce back to what's normal and what is average. So there is a pretty good likelihood that SoFi will bounce back. Now, we are trading in a very tight range right now, so this is just further good stuff, because for me, when there's a tight range, that tells me the stock is actually predictable. That tells me there's not a lot of uncertainty. As you can see here, there was a lot of uncertainty, and that's why the Bollinger Band ended up expanding and ended up being very big, and the stock ended up pulling back, and this only further expanded the Bollinger Band. And now, a lot of everything that could have happened has happened. There's a whole war in the Middle East and stuff like that. So when you look at the stock pulling back in the current situation, this is what I would see as an opportunity to dollar cost average and purchase the stock near its bottom of the Bollinger Band. A lot of people that don't understand the Bollinger Band would be upset with the stock right now. I see this as a huge opportunity, and I'm very excited about it. So understanding technical analysis can really give you a leg up versus other investors, specifically on the mental side.
So let's now talk about why people lose money selling put options. Plenty of people still find ways to lose money with this strategy. So let me break it down for you so you do not get caught up in these biggest mistakes that the most common people do make. Mistake number one, which is selling puts on garbage stocks for premium. You're just chasing the hottest stocks. Maybe that's a speculative biotech play. Maybe it's something like an IONQ or a Rigetti or whatever those stocks in the quantum computing sector are. They're super volatile. Chasing those stocks, not really a good idea. There's a reason that those stocks oftentimes can drop by crazy amounts, right? Quality companies pay less premium, but they don't go down to zero. So would you rather make 2% a month on Microsoft or maybe 10% a month on Rigetti, but then the next month it goes down and or whatever, not high quality companies. So that's the first one. Mistake number two is sizing your positions way too large, just way too big. This is the account killer. Someone with $50,000 in their portfolio sells a single $450 put option on Tesla. That's basically a majority of your portfolio. Tesla drops 30%, which it has done multiple times, and you're assigned. Now you have 90% of your account in one underwater position that you can't really diversify. So that's mistake number two. Mistake number three is fighting the trend. So a stock is in a clear downtrend. Again, trying to catch a falling knife can be very dangerous. Lower highs, lower lows, it breaks support levels. So the premium here is very juicy, of course, but the risk is just way too high. So, again, chasing stocks that are just in a really downward trend, not a good idea. Mistake number four is just not paying attention to earnings and events. The premium that you collect could be really high going into an event, but that event could cause the stock to basically crash, right? Or going into earnings, it's really good actually to sell put options in many ways, because when you sell a put into earnings, the volatility is going to be really high. That's cool. But then after earnings, there's an earnings crush. So it's good actually in many cases to get in before earnings. After earnings, there's just no volatility there. So it's going to have very low premium. You're not going to really make much money at all. So really paying attention to earnings events. Mistake number five is not really having an exit plan. So before selling any put option, know what you're going to do if the position goes against you. Know that, do you like this stock enough to hold it up until the very end if you do get assigned? That should be most of the time. But in some cases, if the stock breaks support levels, what's your exit plan, right? Will you take assignment, or will you plan on rolling it lower, right? Or will you just close it for a loss? Without a plan, you make emotional decisions in the heat of the moment, and it's usually really bad ones. So mistake number six, over leveraging with margin. Now, this is something that I didn't really teach you in this course, and I'm not planning to, but some people are, they're going to use margin themselves. They're not going to get coaching from me. They're just going to do it themselves. In this case, you can very much make many errors with margin, because a lot of brokers will actually let you take a good amount of margin. People think it's free money. It gets really easy to create income during good times, but in bad times, they end up getting a margin call, and then they end up losing a ton of money. So using margin can be very safe most of the time, but then 1% of the time market crashes, you end up in a super bad position, right? So just not managing your margin maintenance is mistake number six. Mistake number seven is chasing losses with more aggressive puts. This is like the casino typical psychology, right? You go bet on blackjack, you come in with $1,000, you're up and you made a lot of money, right? You don't get off the table, you end up losing a lot of it, and you go, all of a sudden you catch yourself at $500, right? So you went from $1,000 to $3,000 down to $500. And now you're like, hey man, I just want to break even. That's the awful mindset, right? That's chasing your losses and basically being in that gambler mentality. Very, very wrong way of trading this strategy. Just take the loss. If you have a loss, learn from the lessons, move on. The psychology trap is pretty real when you have a lot of profits and then some of those profits end up, getting away from you and you lost some of those profits. And now the market has humbled you, but you are angry, okay? Anger is not a good place to put in the market, okay? Maybe you go to the gym or the punching bag or whatever, but it's not a good place to put your anger in the market, because if you will chase and revenge trade, you will absolutely lose even more money. All right, let's talk about portfolio allocation and diversification. Proper portfolio construction is the difference between consistent returns and boom-bust cycles. The core principle is never have more than 20% of your buying power in any single position. With a $50,000 portfolio, that means $10,000 in each positions. This might seem limiting, but concentration risk can be a real killer. I already mentioned how some people, they sell a put option on Tesla, and that's their entire portfolio. It's like 90% of their portfolio, and when it goes underwater, you got some really big issues now. This gives you proper diversification, liquidity for other opportunities, by the way. So if you have several positions, one position, is doing okay, but you see a really good opportunity, it allows you to actually sell that position that you don't really like as much for the new opportunity that has just come up. So for a $100,000 account, $20,000 is pretty much the highest you should ever go on any one position. And then having cash, again, as we discussed earlier in this course, is also a good idea. It could be between 10 to $20,000 of your portfolio. 20% can be in financial stocks such as banking, insurance, payment processors. 20% can be in consumer stocks, well, whether it's retail, maybe that's a Nike, restaurants, maybe that's a Chipotle, or other big brands, right? 20% can be healthcare. Now, I don't recommend going into specific biotech healthcare stocks. A lot of people think, this company is going to go to the moon. You don't know when it's going to go to the moon. It can go down. It can go down a lot in the short term. It can go to the moon in 15 years. You don't know. There's no time. That is the most out of control stocks there are, period. So when you go for healthcare stocks, go for the bigger companies. Pharma, devices, and insurance is fine as well, right? Now, 20% industrials, materials, energy, I would put those kind of together. I'm not a huge fan of those. I didn't personally have a lot of experience analyzing those types of stocks. I have a lot of experience analyzing technology companies. That's what I did on Wall Street. I was a tech analyst for a year. But if you understand tech deeply, you can go even higher. For me, my portfolio is weighted very heavily into tech companies just because I understand technology. I'm bullish on tech. I'm bullish on AI. I was early on Palantir, on SoFi, on NVIDIA, on many other tech names. And I just understand them very well. I understand the valuation very well. And that's where I have most of my experience working on Wall Street, not only at one job, I've had multiple jobs. They were all around tech because once you have an expertise, you get hired from other, banks and firms and hedge funds within your area of expertise. So I kind of started in tech and I actually started in esports, and I was looking at stocks like Take-Two Interactive, Arts, those type of gaming businesses. And then I expanded more into NVIDIA, and I was actually looking at NVIDIA back in 2016. Very long time ago when it was a dollar stock. It was in the low dollars, like $5, $8, something like that. So, I invested some money, but not enough to be meaningful at that time. I was very, very broke. But you want to really have a concentration in an area that you understand. If you're following me and you're watching my videos and if you're subscribed, you are probably going to be more heavy on the tech stocks, and that's completely okay. Now, do pay attention. Correlation matters. It matters a lot. If 5 stocks that you have, your entire portfolio is only in tech, that could be an issue, right? So although tech heavy is okay, in my opinion, I allow that because I'm an expert in that area. You still want to have the other sectors, right? Now, again, we talked about time diversification. So I just want to really bring this home. Time diversification through expiration dates prevents cluster risk. Don't have 5 puts all expiring on the same Friday. Spread them out. Week 1, you have 2 expirations, and then in 2 weeks, you have another 2 expirations. Maybe it's in 5 weeks, you have 2 more expirations, right? Now, I would also say geographic diversification is also overlooked, although a lot of big US companies, they already have a lot of diversification because a lot of them are multinational companies. If you think of, Coca-Cola, they have Coca-Cola all over the world, whether you're in Dubai, I'm in Dubai at the moment, or you're in Eastern Europe where I travel a lot, or you're in the Middle East, or in Asia, or Africa, whatever. There's Coca-Cola everywhere, right? But also there's even, Nike's everywhere, right? A lot of these retail companies, they're everywhere, right? But SoFi, it's not going to be so much international company. A&D, it is, right? American Airlines, well, in the name it says American Airlines, so they have most of their routes within America. I think maybe they go to Mexico and stuff like that. Now, keep in mind the barbell strategy works really well for puts as well, so sell mostly conservative, far out of the money puts on quality companies, but also take into account the Kepler band. So if you want steady income, the allocation can be 10%, but also few other factors, right, that I already discussed in the technical analysis portion, right? We got the aggressive market chains, we have Bollinger Band, we have RSI, we have moving averages. All of these factors you want to basically create into a scorecard, and the higher your scorecard scores on these 7 factors, the better it's going to be. And one more thing, again, to have on your scorecard is the VIX, right? How high is the VIX? When the VIX is higher, it's actually a great time to sell put options. With that being said, let's go a little bit deeper into the VIX. So the VIX is called a fear gauge for a good reason. When others panic, well, that's actually a good time because the VIX is going to be higher and you are the one that is taking advantage of others as they basically running away, they're selling their stocks at a cheap price, or simply when people are willing to pay more for options, okay? When VIX is higher, options are more expensive. They're more expensive because there's more uncertainty. Uncertainty means risk, and risk and return are 2 correlated things, right? So of course, if you're making a super safe bet in a real estate example, if you go to a good neighborhood and you make a an investment property, then you rent it out, and the house is $1 million, and you rent it out to some CEO or a family that has a take-home income of $400,000 per year, that's obviously pretty safe. That person's probably not going to default, right? If they have a 2-person household income, one person's a doctor making $250,000 and his wife is $150K, whatever, nurse practitioner, then you're pretty much going to get paid on that property, right? So you're going to have lower returns because you're not going to be paying a super, super high rent. You have to be more competitive, right? Now, if you go into like a trash neighborhood, I'm from Philly, you go to like like North Philadelphia, and then you have like these rundown places with not the best demographics of people with jobs, and let's say there's a lot of crime, and the average income is like $20,000 or something really, really low, right? I don't know what it is in North Philadelphia, but if it's really low, there's a lot of crime, there's a lot of defaults in that neighborhood, right? Of course, you'd want to get paid a lot more for your rent, right? It would only make sense that you don't have an A++ tenant. You have a tenant that maybe is in and out of jobs, has a low income, has a low job security. So you get an investment property there, you're going to want more money, right? Same thing with the VIX, man. It's the same exact thing. It's just risk. VIX is risk. Uncertainty, if there's more uncertainty, you want a higher return, right? I'm just trying to help you understand that the higher the VIX is, the more risk that investors are expecting. And the higher there is risk in the market expected, the higher the premium has to be on options, right? Because there's a lot of profits to be made in case that volatility realizes, right? Volatility, the VIX, is basically a 30-day outlook on how much investors expect there to be volatility, right? 30 days ahead. It's actually one of the best metrics that I personally love because it's one of the only forward-looking metrics, right? A lot of people watch the news and they read about, things that have already happened. Fed announced these rates, and then everyone is like, oh, well, because this happened, now this is what I'm going to do in the market. No, that's already in the past, man. You're already behind. Two things I know is building permits for real estate is like, that's a forward-looking number because that's future potential buildings that are going to be built. And VIX. VIX is like an expectation from the market in terms of volatility for the next 30 days. So when VIX is higher than 30, amazing. That is a time where you should be deploying a lot of your cash to sell puts because your put pricing is going to be higher. That is what you want versus very low volatility. Yeah, we're in a pretty bullish market with no volatility. Well, selling a put option is going to be like, you're not going to be able to hit 1% a week. That's one of my goals in my program is I want to get 1% a week in premium collected at least. So let me show you the real numbers right now of how the VIX looks and then how it impacts put selling prices. So VIX is super interesting because the higher the VIX is, that's basically the fear gauge on Wall Street, and higher VIX means that option premiums are going to be elevated. When option premiums are elevated, it's a better time to sell. Right now, VIX is sitting at 16, but you're watching this in the future at some point. Anything that is basically above 20 is essentially elevated levels where option selling is good. Anything below 20 is you can still sell options. Like you still want to sell puts on a long-term basis, but it's not going to be really as profitable. Here, we can see that in November, VIX spiked up to 26. Then in October, it was also at 25. But usually VIX has been pretty low because we've just been in a really good bull market. Now, of course, April was when VIX went absolutely wild to 50. And if you sold puts here, you would have literally collected like gold bars, like super heavy gold bars that you cannot even lift. Right now, if I go back 5 years, we all know, actually 5 years ago, wow, COVID times were also elevated, right? So you want to actually look at VIX when it's higher as a opportunity to sell more put options because it's going to directly impact your implied volatility. Now keep in mind, there is something called mean reversion. Mean reversion happens in technical analysis, but mean reversion also happens with volatility. So when the VIX is high, it is going to come down. There is an average VIX of like 17 or so, right? So if you're higher than 17, that's a little bit better of a time, right? If it's higher than 25, that's a good time. If it's higher than 35, man, like you should be deploying your capital like no tomorrow. You should be going to your bank, Mr. Bank, I need that money. I need to deploy that capital into the market. And of course, the bank's going to say, we lend your money out. We don't even have the cash. Anyways, you see what I'm saying? You want to deploy that cash, right? And here's one of the traps. Volatility clusters can be a really big issue. So if the VIX spikes in the short term, like it did back in March 2020, the VIX stays around 30 for 2 months. That did happen, right? We had some more tougher times, right? We had a pandemic. Then put sellers can actually be very, very fortunate. Okay, so that's a time to take an opportunity, but it's also a time of higher risk. So of course, if you have a pandemic, and then you might want to take a little bit easy. However, I'll tell you that I turned my portfolio from $100K to $700,000 in that pandemic. That was when it was super profitable for me to trade, and I've used several strategies that I talk about on this channel pretty quickly. Like it was very, very quick. So opportunities is actually the time to make literally millions of dollars. Like people have made millions of dollars in times of crises, right? So just because there's a pandemic and there's issues and businesses are closing, that's just one pocket of the economy. There's other pockets of the economy that are absolutely killing it. The mental game of put selling is what separates long-term winners from really long-term big winners. You can know all the technicals, you can know everything else that I've talked about, But if you end up getting assigned on a position, changing your mind, getting out of that position, one mistake could literally wipe out $5,000, $10,000 or even more in profits. And every single year over a decade, you can end up making $100,000 less than you would have if you have known these psychological tactics that I'm about to discuss right now.
I study a lot of psychology because the market is a tremendous amount of psychology. So it's really important, no matter how boring you think psychology is, it is extremely important to your profitability. All right, our first lesson is going to be overconfidence bias, which is really interesting, and I'll explain to you what this looks like. So first of all, I'll give you a shocking example of overconfidence bias. And that's that when they have surveyed drivers, okay, 80% of drivers believe they are better than the average driver. Doesn't really make sense. 80% of drivers believe they're above average, but by definition, average means that it's 50%. So that means you'd be better than half, and then you'd be worse than half. But 80% of drivers said that they're better. So that explains to you that overconfidence is most people think that they're much better than they actually are. And I don't mean to hit any egos here, but we all have an ego, but you're probably not as good as you think you are, because we all have blind spots and we all have room to improve, right? That's what I always think. I've been doing this for a decade now, and I have one portfolio that I've grown to 3.5 million. I have a second portfolio that's also around that same value that I've both grown over a long period of time. And I'm still, luckily, I don't know why this is, but I've just been really humbled. I did a lot of martial arts or maybe whatever. I don't get overconfident in my portfolio. I am just as good as my last trade. That's what I always tell myself, okay? Same thing with Amazon CEO, right? Jeff Bezos basically said he expects Amazon to one day go bankrupt. He expects there to be competitors. He expects that Amazon may come into issues down the road, and they must function as day one of the company, okay? Guys, I want you to have the same mindset, all right? Because this course, my chapters will teach you things that will help you trade, and it's most important for you to have a good mindset. That's like basically having good hygiene or good health, right? You can't, it doesn't matter if you're the smartest person in the world. If you don't take care of your health, it's useless, all right? Same thing with psychology. If you don't take care of your psychology, you are going to get yourself in a big pit when it comes to investing, because I've seen students that are like, I made $11,000 the past 2 months on my $150,000 portfolio. Fantastic. I asked him, how long you been trading for? He said, 2 months. That's my first 2 months. I said, beautiful. That's amazing. How did you do that? He's like, I've been just watching your videos. Fantastic. But obviously, it's been 2 months. The guy is having good performance, but he definitely has a lot of blind spots, right? He definitely has overconfidence bias. I said, we should coach together. He said, no, I'm going to keep doing it myself. No problem. We're going to see what happens there. But I just want to say that the more you know and the more you're aware of potential mistakes that you can make and not getting overly cocky, the better, right? I'm not saying something bad is going to happen. I don't know, right? But I do see that overconfidence bias affects people very negatively. They have many good months, and then boom, they have one bad month, and it's not that hard to blow up an account. It also doesn't look as bad, but it's actually bad. I see people that have a 45% return in 6 months, and they're very confident, like, oh, I'm going to do fantastic. They have 1 month that's losing, which is negative 8%, which isn't even that big of a loss, right? Negative 8%. The next month they have negative 2%, right? And then the next month is, let's say, 0%, and they start getting revenge trading, okay? I have a student that I actually will put on this channel that I talk to in my Wheel course, which is coming out very soon. Make sure you're subscribed for that. I have the best courses coming out for free on YouTube. It's freaking insane. I'm just putting everything I have here because I'm super motivated to help you guys learn. I love what I do, and I just want to be the #1 coach here and give you better free information than people charge for. So look, what I was trying to get at there is that if you have a 45% return and then it's negative 8, then it's negative 6, and then it's negative 2, your overall 1-year return can actually be 20%. That's crazy. You can start off with a 45% return in the first half, and because your second half is bad, you end up with a 20% return. It is not a sprint, guys. It is not a sprint. This game of investing is a long-term game. That's why I don't get emotional when it comes to investing. It's because I've been doing it for 10 years. I see the market fall. I'm like, yeah, oh well. I see the market going up. I'm like, oh well. All right. There's a story of, if you have the attention span for this, by the way, congratulations, because you're going to be a better trader. People that don't have an attention span, they're bad at trading. So congratulations for being in this part of the video. So once upon a time, there was a Chinese farmer whose horse ran away. And that evening, all his neighbors came around to basically say, we're so sorry to hear that your horse ran away. This is the most unfortunate. The farmer said, maybe. The next day, the horse came back bringing in 7 wild horses with it, right? And in the evening, everybody was like, your horse came back and it brought 7 other horses, man. Congratulations, now you have 8 horses. The farmer said, again, maybe.
The following day, his son tried to break one of the horses, and while riding it, he was thrown and broke his leg. Okay, and the neighbors were like, "Oh, that's such bad news. That's so unfortunate." And the neighbor said, "Maybe." The next day, the officers came around to script people for the army to go to war. All right, and his son had a broken leg. So again, all the neighbors were around saying, "Wow, you got so lucky. Holy moly, your son doesn't get to go to the army to fight and potentially die," right? And you guys can guess, the story's almost over. The guy says, "Maybe," right? It's really impossible to tell whether anything that happens in it is good or bad, because you never know what will be the next consequence or the misfortune, all right? You never know what will be the consequences of good fortune either. That story kind of paints you the picture that it's maybe. Every trade is a maybe. Don't ever get hard on yourself. If a trade doesn't go your way, it's okay. Make sure that you're playing the long game. It is the long game, right? The guy broke his leg. They said, "Oh, that's such bad news." Well, he said, "Well, maybe." And the next day they came to draft the army and it was good news, right? So bad news can be good news can be bad news. Similarly in trading, most people think that they can consistently outperform the market, but studies show that over 90%, so I said over 80% of drivers think they're good. Traders are even more cocky than the drivers, okay? So 90% of traders, of active traders, underperform the S&P 500, yet 90% of people think that they can beat the market. Guys, 90%, are you kidding me? 90% of active traders can't win. It's good that I teach option selling and collecting income with the wheel strategy mainly on this channel. Overconfidence can be extremely dangerous, especially if you're making money and then you start buying options. Okay, I've seen that happen. I've also seen people just increase their deltas and chase higher and higher premium. And then all of a sudden you see them selling at the money puts on GameStop, or at the money puts on Rivian, or at the money, puts on high, really, really risky stock. So make sure that you're aware, guys. If you're aware, all right, and I'm a man of faith. For me, it's important to understand who I am, what I'm doing for other people. It's important for me to have a good connection with God. That is very important for me. And whether you're religious or not, I want you to understand that being more in tune with yourself and understanding yourself actually makes you better in all areas of your life. It makes you better at relationships. It makes you better with other human beings. It makes you a better person overall, but it also increases your results, okay? I'm a firm believer, right? I wasn't always like the most religious guy, but as time goes on, I'm building a relationship with God. I'm building a relationship because I've achieved everything I could possibly hope for, and now I'm giving it back to you. And I'm thinking, how did I do this? Well, maybe some of it is luck, maybe some of it's hard work, but I really think that I've actually been doing the right thing in life, which is why I've gotten success. So I want you to have that same mindset, which is, always be humble. Be humble. It doesn't matter how much money you have. I have a ton of money. I have more money than I show on this channel. I have enough money to do a lot of things with, right? But I'm not getting overly cocky. I'm still showing up here on this YouTube channel, even though I don't need money. I'm still showing up. Yes, I have a business. I'm a coach. I have a big team that I want them to do really good. They have families to feed, so I do charge for my coaching, and I have an exclusive luxury coaching. I work one-on-one with folks. But it doesn't stop me from understanding who I am, being humble, and not getting overconfident. And also, a study published in the Journal of Finance found that overconfident traders are 60% more likely to trade options excessively, believing that they can predict short-term market momentum or movement. Even in good times, you have to prepare for the tougher times that can potentially come. Even when earnings are good on a stock, right? You see it all the time. You see earnings that are good, the stock can still go down. So it is always humbling, actually, when I predict the stock to have good earnings and has good earnings and it still goes down. I say it's a good thing you had proper risk management. It's good that you had proper asset allocation. I remind myself that I'm humble going into the trade because I have diversification. I knew that the stock would beat earnings, but the market didn't agree with me. The market can still go down. So I could be a genius and predict everything, and I could still be wrong because this is a very humbling game. Also, I just want to say that when you're excessively trading, even if you're right, excessively trading in general is also bad behavior because this behavior often leads to higher transaction costs and on average, lower returns compared to more cautious traders who limit their volume of trades. That's why in my community, I'm just following literally 15 to 20 stocks and I just run the wheel, sell puts, covered calls. I do some spreads as well. For sure, it's easier for me to focus on folks that have $50,000, $100,000 portfolios or more. It's just easier to scale. So I do prefer working with folks that have at least, $25,000 to trade would be kind of like the bare minimum. If you want more help with selling puts, you want to see all of the trades that I'm making live, then I do that all the time. I do that every Monday and Wednesday. I'm picking positions. I'm doing the research for you. I'm saving you a lot of time. I've been doing this for 6 years now, and I've taught over 2,000 students. I have a lot of content and information that I cannot share on YouTube. Some of it is just a little bit maybe more aggressive, such as margin selling it.
and some of it I just save for the community because I want to help people further, and then I actually love working with people on a one-on-one basis. So if you want more coaching and you want to learn more about my program, click the first link in the description. Also, one last thing, okay? With selling puts, now that you have mastered it, if you rewatch this content, really learn it, get the, solid knowledge through this, selling puts is just a gateway. It's a door into the wheel strategy. And I also have a free course for you to watch further. And that course is for sure going to level you up and take you to the next level with option trading. So check out that course right here on the screen right now.